You go away for 1 week and everything collapses. How are we all doing? Morning. How is everybody? ADR dashboard kind of tells the story of what's going on at the moment, doesn't it? Look at that. Average daily ranges, weekly ranges, monthly ranges. We're on the 5th of the month. We've done 175% of our monthly range. Mental. So yeah, we'll have a look at everything this morning, see if we can figure out what the hell is going on. And yeah, so how is everybody? 1 week off. The entire world's exploding. Morning, Steve, Pot DJ, Callum, Evil, Yotko, Virginia, Gregors, Ryan, JC, Wojciech, never say your name, Thurwus. Morning, Duncan, Sarah, Eze, how you doing? Lucas, Segar, morning. Right, so yeah, back from holiday. Wow. I was watching all this unfold while I was on holiday. Last month was a bloodbath, basically. It's the biggest loss I've had, full stop, 28%. Can't really say anything about it much because, as you can see, I mean, I've got the pound Swiss up here as an example. At the where's my pen? The RSI levels we're experiencing at the moment, the relative strength in this market is that word again, isn't it? Unprecedented. This is the 20 level on the RSI, which is the big extension on the 4 hour, which when we get to, you know, it's incredibly rare. You don't make money out of these type of extensions when we get them. We're sitting down at the moment at 4.68 on the pound Swiss. Never been there. There's a lot of instruments at the moment. This is the extreme look. That's the most extreme move we've had on this pair pretty much ever in 10, 20 years. We're beyond it. So there's something, I mean, I don't even, it's difficult to find words for the strength of this move. Look at the size of that sell-off, which has happened in less than a week. That is a big move. That is a big move. That is just never seen. So there's something quite dramatic going on in this market at the moment. I took the last 3 days off to do some analysis, really, of what is going on, do some testing. We've got 300 plus ADR days gone in again today. So this is a culmination of US dollar dropping interest rates after saying they're not going to do anything until 2025, then deciding actually we might do 1.5% in the next couple of months. The pound delaying theirs too quickly, suddenly that happening. We've got massive moves happening at the moment because of what's going on in the Middle East. We've potentially got World War III breaking out now in the Middle East. US has got to get involved with Israel. Everybody is attacking Israel. Everybody's going to get involved in the Middle East. We've got Aussie and New Zealand markets collapsing. The stock markets this morning are down. We've had, you know, it's just like there's a culmination of things going on at the moment which haven't happened at the same time before. And it's just causing these incredible moves. Couple that with the fact that we're in summer trading now, light liquidity. Light liquidity equals massive slippage. So what you're getting is huge amounts of potential buy and sell orders wanting to come in at the same time. No liquidity available. So if you want to get those orders executed, you need to take a worse price, which means you need to push further, which means you get these big slippages. That is also coupled with the fact we've had the lowest ADRs in over a decade. So we've gone through the lowest ADR period. I've got an ATR. Let's put an ATR up, I'll show you. We're going through the lowest ATR period we've had for a long time. Yeah. So these ADRs basically, we dip into these sorts of levels every now and again, but we've had a sustained drop in ADR for over 12 months, which is the lowest it's been over a decade. We are now coming into the largest expansion and volatility period after the lowest ADR. It's just a combination of a million things at the same time that have not actually occurred before. So where this market goes from here, no clue. I don't mind admitting it. I ain't got a clue, because I don't think anybody's got a clue, which is why we're seeing all this panic selling at the moment. So everything is moving dramatically. I've got gold up today. I know I don't normally trade it, but I'm not going to trade it. But I've got gold up today just to demonstrate a point that this is not US dollar based, what we're seeing today. Yeah. So if the gold is the inverse of the US dollar. So if you get massive moves in the US dollar, you get the inverse massive move on gold. If it is a safe haven related move, you get a massive move on gold. Today, we've had an ADR hit. That's it. Yeah. We've got 300 ADRs on other instruments. So this is not US dollar related. This proves that. So it's just a massive confluence of, you can see the ADRs just, well, this is an hourly, but ADRs are just kicking off at the moment everywhere. So we need to sort of sit back. But this is what I'm doing anyway, sitting back and waiting to see what the market is going to do with all of this information. So these moves that we've had this morning, you can see a massive spike to the upside on the US dollar. They're dropping interest rates. That's what happens when you drop interest rates, not that. Yeah, so these moves that I said in Telegram this morning, these don't look right. These are the wrong direction for what we should be experiencing with what's just happened. We've had the Fed futures this morning. A 60% chance of a 25 basis point within 1 week. We've had the Fed market 1.25% lock in today for the futures. So we remember last month we were saying, or rather the Fed was saying, we're not going to change interest rates until probably September. The month before that, they were saying they weren't going to change it until 2025. So we've gone from not changing interest rates to dropping by 1.25%. As we stand at the moment, this will change on a weekly basis. But from 6 months' time to next week. So this market has got no time to react. It's just panic buying, panic selling. And I think we're going to see this volatility continue, which is fantastic for most strategies, breakout strategies particularly. But for any trend-based or mean reversion strategies, you won't get in any trend pullbacks if this continues. Mean reversion, it may not. So it's very difficult to trade this type of situation. It's one of those periods where you just have to sit back and go, nothing's going to work in this. The whole premise of trading is, as a trader, your job is to be net short or net long when the market moves. That's it. That is all you can do, because this thing moves at random. There are no 2 days that are ever the same. And your job is literally to be on the right side of the move at the right time with the right bias, long or short. That's it. So all you can do at the moment is sit there and hope that there is an explosive move, which is what we've been experiencing for the last 12 months, isn't it? Sideways explosion, caused by fundamental news, usually. That's all you can do, is sit there and wait for that to happen at the moment. So, yeah, we'll go through all the pairs this morning. But, I mean, the ADR dashboard says it all. We've got over 225 ADR on virtually every instrument at the moment, or, you know, at least 175 ADR. Weekly ranges. It's Monday morning, yeah? The market opened 10 minutes ago. We've got 175% or 225% on Euro odd of the week's range done before the market's opened. You can't trade this. It's just unbelievable movement. There's nothing you can do with it. You can't get on it. It's gone. If you want to mean revert it, good luck. Is it coming back or not? No one knows. So the only play you've got is to try and get on the opposite move. But with a lot of this stuff, you've missed it. It's already happened. Yeah. That move there is 140. That's over an ADR. That wick there is over an ADR. So, you know, in that candle there, in that 1 hour candle, we've moved 200% ADR after a 150% ADR move. And we've pulled back an ADR all within an hour. It's just untradeable. You've got to wait for this thing to calm down and just see where it decides to go next. So I'm sitting on the sidelines. I got flat, thankfully, on Thursday last week. Thursday evening, I decided to take a 2.5% loss on the rest of the portfolio to get myself flat. to give myself time basically to see what's going on, and I'm so glad I did. But at the minute, it's just a waiting game. So we'll look through all the pairs this morning, but it's impossible to analyze this really, because it's just not something that has occurred before. These RSI levels that we're seeing on the RSI dash, we've got, this is the RSI 14, yeah, and the reason the 80-20 level is on there and no higher is because we rarely get to 80-20. When we get to 80-20, it's an A triple plus setup. It's overextended beyond normal reams. Yeah, you're going to look at possibly one signal a month on that level. We've got virtually all pairs, not only at that level, exceeding it. We've got 12s, 14s, 6, 5, 6, 10, 14. I mean, these moves are just off the charts, aren't they? So when you see these situations, a lot of people will want to jump on board. And there is a very high probability of making a lot of amount of money. There is also the probability of you just getting crucified for the next week. Yeah, until we know why and how and what the potential next move is going to be, it is just a coin flip. And there's nothing wrong with that. At the end of the day in trading, all you've got is a coin flip. It's going to go long, it's going to go short. There's nothing that's in your control. There's no signal or system or strategy that can tell you what to do right now. You just get in if you want to. But if you get it wrong, what will happen to you from a psychological basis is every single trade that goes against you, you're going to want to get it back. So you're going to X2 every trade after that, and that's it. It's all over, usually, unless you get it right. If you go long now and it goes up, brilliant. I said in the Telegram group this morning as well about this US dollar move. US dollar interest rates are coming down by 1.25% potentially for the rest of this year. That we've been waiting for this announcement, waiting for something from the Fed to give us that guidance, and we got it last week. That is massively bearish for the US dollar. What we've just seen this morning is a massive bull move on the US dollar, completely the opposite to what the fundamentals, as you can see from last week, should be doing. Yeah. So this does not, and I said this morning in Telegram, this doesn't look logical at all to me, this move this morning. It's just some kind of massive knee-jerk reaction that we need to wait for it to settle down. So for me today, I'm not interested in anything. I'm not taking anything. I'm just going to sit and watch and keep a close eye on financial juice and see what basically they think is going to be happening next. The other thing as well, look, we've got the ECB interest rate cuts now also looking to be extended. So more rate cuts than expected this year. So these sticky rates that we've had for inflation, when I can find them. Oh, I fixed all this by the way. Anybody that has been trying to use the sentiment and the directional bias scorecard for the last few weeks, I haven't noticed because I haven't been looking at it much in the live rooms. It's been absolutely fine for me. When I'm logged into the website, the cache turns off. So I've been looking at it going, there's nothing wrong with it. People have been telling me there's a problem with it. So I went into incognito mode and looked at it and discovered that the cache system was broken. So I've refreshed all of that this morning. Well, not this morning, last week. So it's all working now. So if you were watching it, it wasn't working. It is now. But yeah, so if we look at these interest rates and these inflation figures, inflation was expected to bounce. We were all fully expecting, and so was every banking institution. Remember the Lagarde came out and said it. Fed weren't using the word stagflation, but they were stuck. The ECB said we're looking for a bounce. The Bank of England said we're expecting a bounce. We haven't got those bounces. So again, the banks, central banks, got it completely wrong. They were too slow to drop, and they have got now disinflation coming much faster than they were expecting. So everything in this market at the moment, the banks are getting it wrong. Everything is just being got wrong. So we can potentially see these interest rates now that we were expecting for a 0.25% freeze, which is what most banks have been estimating to turn into a drop every single month, and not just 0.25%. The Fed coming out and saying we're not going to change interest rates till 2025 have now come out and said we're going 0.5%. Not even 0.25%. We're just going to go straight in with 0.5%. So with this type of volatility and confusion and amount of error making by central bank and government at the moment, this thing is going to be wild, I think, for the next few months. We've also got the fact that we've got low liquidity in summer, and we've got this thing kicking off in the Middle East. Yeah, rockets. We've got evacuation orders from the US, from Europe, and from the UK now. Yeah, so they have been told in no uncertain terms, get yourself out of Lebanon, likely to get bombed soon. They can't because there's no flights. No one's flying in and out. So we've got a load of overseas expats from all countries stuck now in Libya. So that is a massive flashpoint, which we were kind of expecting to come at some point. So again, things like the Swiss franc, you're going to see massive safe haven runs into the Swiss franc. The yen is on the back of its biggest move. We have sin. I mean, this, I've been talking about this for seems like the last 12 months, waiting for this to happen, and it hasn't happened. And it not just happened, has it? It's completely undone. This is December this year. This is the last 12 months worth of price action. Yeah, gone. The whole lot. Talk about climbing up the stairs and falling down the elevator shaft. I say it in here almost on a weekly basis, probably on a daily basis. This is how the market moves. It doesn't normally move like that, does it? Yes, we fall down the elevator shaft, but normally to 50% and not that fast. So, you can't read this price action with any kind of historical precedent. There is no precedent for this. So quite what to do in this market, don't know. Best thing to do if you're unsure, was one thing that's stuck in my head from one of the mentors years and years and years ago and has never left me. If in doubt, stay out. If you don't know what to do, don't do anything. There's 3 positions: long, short, flat. Yeah, flat is the one you want to be in at the moment, because this thing could go anywhere at any speed at any time. It could also sit there for summer trading and sit there for 4 weeks now and do nothing. We don't know. But the moves are in the wrong direction to the fundamentals a lot of the time, and they are way, obviously, as we can see, faster and harder than we've ever anticipated or seen before. We've got the US dollar yen going from this massive rally to an extension higher than we've ever seen, to an extension lower than we've ever seen within 2 months. It's within 3 months, isn't it, really? But unbelievable. So we'll look at all the pairs from a fundamental perspective this morning, and see where potentially stuff could go. But indicators at the moment are absolutely useless. Doesn't matter what your system is, what your strategy is, what your style of trading is, what indicators you're using, none of it's going to work. Yeah, because these moves have thrown every indicator available, of which I learned the other day, there's over 1 million indicators for MT4. 1 million. Well, it's about 800,000 actually. But, 1 million-ish. And they're all telling you the same thing. What's happened in the past? Useful. So yeah, it's funny. I was doing a load of research last week and I found out a lot of information I didn't know. Anyway, but yeah, so there's no point in looking at RSI dashboards today. There's no point in looking at ADR dashboards today. It's, as you can see, it's a bloodbath. There are institutions all over the world going pop right now, and getting into all sorts of trouble. There are institutions on the other side of that going, this is just too easy. And they haven't done anything. They just happen to have the right bias. I was told again many years ago, the only way to make money in this market is to be net long or net short at the right time. You don't know which the right time is. You just need to be net long or net short. Yeah, this is why a lot of people hedge and a lot of hedging strategies exist, because you just keep changing your bias until the market goes like this. That's when you make your money, but completely unpredictable. So we'll see. So we'll go through all the pairs this morning. We'll have a look at the fundamentals, just have a recap. So we'll start off with the news. Let me just catch up on the chat. Morning, everybody else I haven't said hello to. Antonio, Danny, don't leave again, they know. I was sitting on a sun lounger in Turkey, and my phone, I turned on push notifications on my phone, which I never do for MT4. And I turned on push notifications, and I've never heard something go off so much in my life. It was just like ping, ping, ping constantly. And I had to turn it off because it kept making me look at the bloody thing. I was obviously getting into trouble. But try watching what's been going on unfold over the last week. It's just nothing you can do about it. So you just have to sit there, take stock, and go, right, what next? Which is what I did last week. So I've done a load of research, which I'm not going to go through all of my research, but I've done a lot of research on RSI, on ADR last week. I did a lot of, I'll go through this in a minute anyway, but I did a lot of research basically, and redid my ADR research, which was the important thing because I wanted to see what the relationship between these moves in ADR was. And confirm for myself, really, more than anything, that there's not a lot you can do about these situations. So you can plan and change your systems and strategies when things go wrong. But what you will find is the new system or strategy is just curve fit to the current market conditions, and you can't use that. So I'll go through that in a minute anyway, the research side of things I've been doing. Morning, Ismet, Chucks, Neo. This could be the reason for US dollar up. What could? Morning, Ross Weether. No soft landing. No, I mean, this again, we've had nothing from the Fed, and if you've been in here with me for the last 6 months, obviously I've been like a broken record about the US dollar and the pound being too slow to reduce the interest rates. If they go, and I've said it many times, if they go too late, they will go into disinflation. Disinflation will cause recession. This will all go badly wrong for them. I'm trying to think of a word then that wasn't swearing. But it will all go very badly wrong for them if they do not start to do it. This is what the problem is now. It's they've gone too slow, they've gone too late, and it causes absolute chaos. Couple that with what's going on everywhere else in the world at the moment. Wars cost money. Ain't got any. No one's got any. This is the problem. Ukraine have been using all of our money and our weaponry to fight Russia. Now what we're going to do when we need to? Yeah, we've got no troops in the UK at the moment. We haven't got enough soldiers because we've whittled it away because we've been in peacetime. The trouble with peacetime is it stops like that. And all of a sudden you're like, oh, who's going to fight? Yeah, there's a lot of money problems. There's a lot of all sorts of problems. But the soft landing side of things, it looks like from the Fed now, this sell-off that we're going to see on interest rates is a panic. Try and stop that recession happening. And the market hasn't priced that in because we've not been lied to by the Fed. We've been told something different by the Fed for the last 12 months because they didn't know. And it's pretty evident from these moves that we're seeing. They don't know. Nobody's known what is going on or what is going to happen. And no one's been in control. I thought the euro, Lagarde was the one that was, and they always have been. The ECB have always been very, very spot on with their analysis on interest rates, inflation, what's going on everywhere. They are, obviously they've got the German economy in the European Union, and Germans are very precise. They're very good at forecasting. They got this totally wrong. They got to drop their interest rates way faster than even they expected. Look at this move on the euro against the US dollar. Euro interest rates have come down already, yeah, and are forecast to come down faster, which is massively bearish for the euro. This thing's flown up like 300 ADR in 2 days. Yeah, it's just, these moves are as illogical as I've ever seen in the markets. But then again, as I said, I've never traded through a situation like we've had. So, this is where I've said many times, the market will stay irrational longer than you can stay liquid. Got to get out flat. Euro pound. Yeah. both interest rates dropping. Why then would that? It's just not normal, is it? So there's other things going on here that you just cannot predict. So all about risk management at the moment, which brings me on to the EA changes I've made, which I'll also go through this morning as well. It's probably time to rename the channel to the Unprecedented Market Structure Trader. Yeah. It is unprecedented. You know, look at these levels. I mean, this is the thing. You can, whatever system or strategy you ever trade, you will always find a situation that you've never been in before. Because all systems and strategies are based on backtests. Backtests are historical information. Historical information does not repeat itself. I've said this many times. You go back, and I've used AI to do this, not over a long period of time, over a short period of time, but I've used AI to analyze a chart and show me the same price action intraday on 2 days. Doesn't happen. Yeah. You do not get the same moves intraday ever again. So every single test you've ever done on any strategy, visually or using automation, has just been telling you what would have happened in that situation that will never occur again in the future. All you have is risk management. Market will move up and down through time randomly. You have risk. That's it. The only thing as a trader you can control is your risk. There is nothing else. Systems and strategies are just entry methods and exit methods of getting in and out of a market, which is random. So, you know, these moves here, yeah, you can't test for this. What happens when it gets up to here? Don't know. Never been there. This is the first time ever. So someone in the future, in 10 years' time, will be going, do you remember back in 2024? That was the first time we ever hit that level. Well, we've hit it again. We should be, don't know, what should we be doing? So, yeah, anyway. So they get chat caught up on. Hi, FTNet, Vitaly, morning. So this week's news. I'm not going to go through what's happened over the last week. Pretty evident. Hopefully you've been keeping up with it. But the Fed are cutting interest rates. The euro are going to cut their interest rates faster. The pound have cut their interest rates, and they are also going to need to do it faster. So basically, it's a mass sell-off by the banks to get those interest rates down as fast as possible to stop disinflation. We've got the Aussie, which is bouncing from an inflation perspective and hasn't changed yet. Massively weak. Yeah. So we've got commodity pairs moving at the moment to the downside dramatically. Yeah. When they're not changing interest rates. What happens when you don't change interest rates and everybody else does, i.e. drops them? You get bullish. What's happening to the Australian dollar? It's getting bearish. Yeah. This is not what happens in normal fundamental analysis. Yeah. This is why the banks have got this all so wrong. These things are not moving. The institutions are not moving markets in the way on the same drivers as they have done in the past. So basically, there's still the same situation. Everybody is selling off interest rates now. So the Canadians have dropped. The Swiss have dropped, as we know. The pound has now dropped. Japan's not going up. New Zealand and Aussie are the only two that have not done interest rate drops yet, including the US. But the US have now come out and said you can knock 1.25 off that by the end of this year. Whether that happens or not, we'll have to wait and see. So from a fundamental perspective, the only bullish currencies are Aussie and New Zealand. Yen, no idea. Swiss will be manipulating as they see fit. And obviously, because if it's a safe haven currency, that will just happen like that. You won't know about it. You won't have time to react. So Swissy still massively dangerous to trade at the moment, and the yen. Also, caveat, flip side of that, massively profitable. If you can get a net long short position on those two in the right direction, hold it and don't get out. Yeah. So that's the current situation. Obviously, inflation figures we've hit for the pound. We were forecasting that to bounce, didn't, or hasn't, or isn't forecast to now. Canadian is getting very, very close, very stable at the moment. The US dollar obviously is at 3%, and they're panicking basically now. That's way too high. This thing could easily put in a 0.7 like the New Zealand dollar. This could put in a 0.7 on the next CPI number, which brings them down to 2.5% with 5.5. Same as with the pound. Too little, too late. So that's where the fundamentals are at the moment. Obviously, everybody turned tail last week and wants to get out of interest rates now, and probably faster than expected. But what's the Turkish CPI? Do you know what? I went to Turkey. For those who don't know. Sorry, just a little sidetrack. Went to Turkey last week, and it's the Turkish lira. Yeah. So I got out a load of Turkish lira to take with me. They don't accept Turkish lira in Turkey. They want either dollars, euro, or pound sterling. Yeah. So obviously I had a bit of pound sterling on me, but why would you take out dollars to go to Turkey and the euro? They're not in the euro. Yeah. And I was talking to one of the guys in the shop, which sells dodgy handbags, about, why don't you want the lira? 60, there it is, look. Inflation's sitting at 61.78%. You think we've got a problem with inflation? Yeah, our target's 2. So's theirs. They're at 61% inflation. They also have to pay 20% tax on everything that they sell and do over there, basically. So they're not interested in the lira. I got 7,500 lira for £200. Yeah, I was carrying around a wad of notes like that. Yeah, and that was 200 quid. Yeah, it's ridiculous. Anyway, side note. Yeah, it's just interesting because as that came up this morning. But yeah, so if you're going to Turkey, take euros. Everything is priced in euros. That's what they want, euros and pounds. So it's a bank holiday yesterday in Australia and today. The Canadian, we have a bank holiday today as well. So this week's news, we have the services PMIs this afternoon, for the US dollar. So this is a key one today. The services PMI is typically the one that has been very, very, very sticky. It has for the UK. It also has for the US. So this is a key figure. PMI feeds into CPI. So we are forecasting a bounce on this today, which would mean that interest rates potentially would go up, which means that the US should not be reducing. Inflation should go up, which means that the US should not be reducing interest rates. They've said they're going to massively. So again, we're going to get potentially conflicting news today as to what the Fed's path is. So if that comes out at 51.4 or higher than the 48.8, that is potentially going to be bullish for the US dollar. The market wants to sell the crap out of that at the moment. So again, be prepared for massive volatility coming in this afternoon on that. What impact it's going to have, no idea. We've got the Australian rates coming out tomorrow morning, 4.35. Again, not forecast to change. No reason why they should be changing. They're still up at 3.8. That's way too high. It's bounced the last time, the inflation figure. So there's absolutely no reason for them to drop it. They've even hinted at possibly increasing it. But again, I don't think that's going to happen. So will it be interesting to see what the monetary policy statement is for the Aussies moving forward. But at the moment, the Aussie should be bullish rather. Yeah. So they're holding interest rates, possibility of rising interest rates. That's nothing but bullish for the Australian dollar. This is not, fundamentals are just not happening at the moment. It's funny, systems and strategies are failing everywhere. Fundamentals are failing. Banks are failing to get it right. So what is working? You pick. Basically all you can do at the moment, isn't it? So that's tomorrow morning. We've got the rate statement coming out, so we'll have a look at that when I come on tomorrow afternoon. We got PMIs tomorrow morning, which is construction, which doesn't really do a lot for the pound. And then we've got the unemployment rate tomorrow evening for the New Zealand dollar. And again, New Zealand unemployment is a very critical part at the moment, because the higher that unemployment rises, the more pressure it puts on dropping those interest rates and making the currency bearish. And again, we saw last week non-farm payroll on Friday for the US. Big figure, big drop. Yeah. So, you've got to watch these unemployment figures, which is why they're on the fundamental scorecard. So New Zealand, we're up at 4.3. It went up last time. So forecast this time, where have we gone, is 4.7 to go up again. Again, it's going to put massive negative pressure on interest rates. They're going to want to drop those interest rates as fast as they possibly can in the New Zealand. But they can't at the moment because their inflation is still too high, although it is coming down quick. So more likely that they will do it first before the Aussies, but we'll see. So that is potentially going to have quite a big impact. Basically, it's Wednesday morning. Nothing on Wednesday. Thursday, we've got Bullock speaking. Inflation expectations. Expectations. It's red. I don't know why, really. It's a forecast. We shouldn't be paying attention to it, but it may well move the market. Unemployment claims Thursday afternoon as well. Again, another big one. And then we've got the unemployment rate for the CAD. Again, 6.4. Canadian unemployment, a massive problem at the moment, which is, again, one of the reasons why they want to get this down as fast as they possibly can. And they're getting closer and closer to be able to start doing those 0.5% drops. So not a massively impacted week after last week, but there is quite a lot of important news in there to be aware of. Obviously, this was the one that killed the dollar last week, the unemployment rate going up by 0.2. Not good at all. So we'll have to wait and see. We have been witnessing week in, week out changes in the stance from the Fed. But this feels to me like this is now on a downward course for the US dollar. So short only US. There you go. Look, that move this morning. Like I said, that's what I said in Telegram this morning. That's not right. Yeah, that is totally the wrong move. Before a reversal, you often get an exhaustion move. That, to me, looks like the exhaustion move on this US dollar. Should be kissing that thing goodbye now. But we'll wait and see. Again, typically you get an exhaustion move before a reversal. Typically, you don't hit levels below 10 on RSI. Typically, when there is a fundamental that says go that way, the market doesn't go the opposite way. So, yeah, that is typically what you see when you're about to get a massive reversal that's going to continue for weeks to months on end. No idea at the moment. Wait and see. So, yeah, some really good signals going in for reversals across the board at the moment. And that should be massively bullish. Yeah, it's the Aussie. They're not changing their interest rates. This thing should have been doing that for the last month, but it hasn't. So we'll wait and see. Can you call RBA and tell them to raise their rates by 100 basis points? That would be nice. It should pop from here. Especially the Aussie. The New Zealand is a little bit more tricky because obviously when you look at the fundamentals for the New Zealand, they are coming down very, very fast on their CPI. But when the CPI drops at that speed, it normally bounces afterwards. What we normally see is a big drop and then a bounce and then a bit. It's a trend, basically. It's market structures. It moves in the same way. So we should be looking at a bounce on that. But they are very, 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 very high. For interest rates, so there's more chance of that coming down before that. So the Aussie, don't forget the market moves in monthly and quarterly cycles. So the fact that we've sold off to this extent in a bull trend happens. Yeah, you can easily, you can be bullish on a currency and it can pull back for a month before it makes its next leg up for the next 2 months. This is what market structure is. It's the market having a bias of we need to be long on this. Okay, let's buy it. And then let's profit take. Okay, let's get in now and add more. And let's profit take. Let's get in, add more, profit take. This is what trends are. This is what market structure is. But that is not a pullback, is it? Yeah. So these moves that we are experiencing at the moment are much, much bigger. There's too many things coming together at once. But that is what we should be testing now. especially if the Fed drop rates. So the next Fed rate drop is, when is the next Fed? Oh. Should we look at this month? No. I've been out of the game for a week, so I need to remind myself when everything's happening. Yeah, so September is the next forecast. So 18th of September is the next forecast announcement. But as we just saw on Financial Juice, cutting in September by 50 basis points. But there was something I saw in there. Yeah, traders price in a 60% chance of the Fed cutting rates by 0.25% within 1 week. So what they're basically saying is we're going to have an unscheduled interest rate change on the US dollar. Can you imagine what a bloodbath that's going to be if the Fed suddenly turn around and go, by the way, guys, we just decided to drop interest rates. We will do a 0.5%, maybe 0.75% in September, but here's 25% now. The market hasn't factored any of this in. If they do that, it's going to be just an absolute catastrophic bloodbath again. So you've got to be prepared for, especially in August and September, when we've got light liquidity in the market because of summer trading. Moves like this, it's just slippage. It's just the market not able to transact these large orders that are going in and just finding the liquidity. And then if the liquidity is 3 ADR away, that's where the orders are getting filled. They don't mind where they get filled. Their purpose is to get the orders executed, either to get in or get out of the market. Doesn't matter what the price is. We're holding it for 3 months. Get in or get out. And this is where you're going to find this extra slippage there, because there's a lot less transaction, a lot less volume available in those markets, which means your ADRs are going to pick up. So, caveat on the ADR dashboard, if you're using it at the moment, you're going to see some big numbers coming in until these adjust. So don't forget, if you're using the ADR that I use, which is ADR 10, what we're looking at here is the average movement over the last 10 days. Yeah. So if the market goes from a calm, low ADR scenario into a violent, wide ADR scenario, your indicator, all indicators lag, your indicator is going to be 10 days out of date. So by the time this gets to levels which are average for the current market conditions, you'll have had 10 days where this thing lights up like a Christmas tree, because it thinks, or it knows, that the ADR was 135. The ADR, and I've said it in here many times before, the ADR at the moment on the pound New Zealand is 148. 3 years ago, I was trading this at 450. Yeah, these ADRs are tiny. This movement at the moment is microscopic compared to what the market's capable of doing. So just be aware, we are probably moving into an expansion phase now. Morning, Franco. Hurricane in the Gulf causing havoc in Florida. It does feel like Armageddon at the moment, doesn't it? I'm half expecting some kind of demon to come out of the Earth's core and go, I was there all along, and burn the entire planet. It does feel like that at the moment. Everything is going wrong everywhere, isn't it? It's mental. And we got robbed yesterday in the skeet shooting in the Olympics. She hit that skeet, our girl. The video replay showed it, but they were obviously blindfolded, the refs. Anyway, enough of that. Morning, Alan. Have you covered Euro and EuroCAD? No, I'm going through everything this morning. So we'll go through that now. So I've covered all the fundamentals. I've covered all of the news this week. So we'll go through all the pairs now and have a look. So I will talk about the research and things that I've been doing as well in a bit. Before I do the analysis on all the pairs, I just wanted to quickly cover, for those using the Position Trader EA, the changes that I released last week. So while part of the reason I made a loss last month, and the size, it's not so much that I made a loss. I make loss month normal. Yeah, 2-3 months a year are going to be losses. It's the size of the loss that was the thing that concerned me last month. The reason mainly for that is the way that the automated drawdown control works in the position trader EA compared to how it used to work in the market reversal alerts EA. In fact, the way that I was doing it in the market reversal alerts EA. So I introduced a new input last week when I got back from holiday, which is the max open trades allowed. So what this does with the drawdown control, rather than using a percentage of each trade, it basically closes the oldest position. So it's basically working on numbers. I've shied away from this in the past. My testing has shown previously that this wasn't as profitable on long term than closing out a percentage of the trades after they have gone into drawdown. But this produces lower drawdown. So it's there's always a payoff with everything you do in trading. If you let something run longer, you will take more drawdown, but the probability of your trade working increases. If you shut your trade too early, you will take more loss, but you will have lower drawdown and your profitability will be smaller. So there's always a payoff, which is why in the bootcamp, I sort of say there is no right or wrong way of doing it. It's a comfort thing. If you're not comfortable in drawdown, you need to close your positions faster. If you are comfortable in drawdown, then you can let your positions run longer. Yeah, but they will have an impact on your profit, your drawdown, and everything basically. So that was introduced. So basically what all that does is if you take a position and then it goes into drawdown and you get to a certain number of trades, when it's got 6 on, in this case, which is set to 6, when trade number 7 executes, yeah, that automatically closes in a loss. Yeah. So you will only ever have a maximum of 6 trades on at once. If you're using lot multiplication and you're using a 1.2 or whatever, what happens is as you go into drawdown and you add more positions in, as these sizes get larger, they have less room to move before they start doing drawdown control. So in a move of these magnitudes that we've had, which we've not had before, what that setting unfortunately does is it hemorrhages cash a lot faster because this is only if you're using a lot multiplier. If you don't use a lot multiplication, which I know a lot of people don't, which is how I teach in the bootcamp, not to do that, you won't have a problem with it at all because it will take drawdown control at exactly the same levels. It's only if using lot multiplication. So this is a better way of doing drawdown control with lot multiplication if you get squeezed. So I've added that in there. I've also added in monetary risk amount as well, because a lot of people have asked for that in the past. So you can now exit on monetary rather than percentage, and you can now take risk on money rather than percentage. So those are the changes that I made last week. Look at this pullback. 2 ADR. So we've moved 300% of ADR. In fact, it's that candle, that 4-hour candle is 300% of ADR. It's done more than that today, but it's pulled back 200% of ADR. So we've had a 3 ADR move and a 2 ADR pullback. It's not even 9 o'clock. Absolutely crazy, isn't it? Anyway, right. So as we're on the Aussie, we'll start with the Aussie. So Aussie pairs, obviously, we've got very bullish stance from a fundamental perspective on these at the moment, which it should be. So what we were expecting was a continuation because the Canadians dropped their interest rates. The Australians haven't dropped their interest rates and have hinted that they may need another 0.25% if inflation stays sticky, which is bullish. But what we've actually had is utter chaos started in the last week, followed by this thing this morning. And as I say, if you go back and look at the biggest, strongest trends they usually end with some big, strong push and then a collapse. Yeah. I mean, not that big. That's more like an intervention. They don't do interventions. So there's an example there. Look. Yeah. So when you get to the end of trends, you quite often get a very large move, which is basically the market reaching a point of exhaustion where there are no sellers left. So if you're moving up, well, let's use this as an example. So if you're moving down, basically the sellers are in control. They've got massive P&Ls, and basically they're trying to sell more. There are no buyers left at this level, so they have to push further. There's no buyers there. They push further. There's no buyers there. They push further. There's no buyers. They keep pushing until they get exhausted, which is why they call it an exhaustion move, because there are no buyers left. You've run them all over. Yeah, the buyers have gone, screw this. We ain't going long. Yeah. So you get, this is why you get the wick. It's basically the sellers giving up, not the buyers taking control. It's the sellers just basically can't get any more orders executed, and then you push back. Yeah. So the move that we've got this morning across the board on a lot of these instruments, yeah, may be seen as bearish by some, but a lot of market participants, institutional participants, will be seeing this as a massive bull move. So whether or not that is going to happen, we'll have to wait and see. We've had so many fundamental shifts in the last week while I've been off. It's kind of almost impossible to tell, isn't it? But the fundamental bias at the moment is long. And obviously, this is an exhaustion move. So good time to be getting into positions like that. And if you have made losses in the last month, holding for as long as you can make you back a very large portion. The 25% months I have where I make profit on my highest month in profit has been 28%. That month basically was a combination of multiple squeezes, very low profit. In fact, I think the month before that was a loss. So a loss month where you're building up large positions, large lot size, and then the following month moving in the opposite direction and undoing that previous month. So when you start to scale into your positions on that move, this is where we make our money on the profit take moves that the banks and institutions do. You've got a much bigger lot size on than you've hemorrhaged there, which makes you make a lot of money. So we have these big weeks and big months where we make large profits because our positions, and like I said, your job as a trader is to have a net long or a net short position in the right direction when the market moves. You can't time when the market's going to move. You can't time how far it's going to go. And you can't tell what's going to move. All you've got is the ability to place a position. So when we have these big positions on, like if you were in this one long rather from there, you're long, you've been adding, you've been adding, you've been adding, you've been adding, you've been doing drawdown control along the way. So you've taken loss on this trade, you're in the hole, you've been adding. If you've added anything in here, you're in profit on whatever. Now, if it moves up to here, you have got a massive position where you can make a massive profit. You've got to try and hold these positions if you're in them. So the fundamentals are on your side. The long-term bias is on your side. Yeah, it's a bull. Yeah, it's a higher low. It's a bull market. Yeah, fundamentals, maybe increasing interest rates, have already dropped and are going to accelerate the drop. Canadian, always pulled down or pushed up by the US dollar. Which way is the US going? Down. That's going to help that go down, which helps this go up. Yeah, so everything is pointing towards bullish fundamentals at the moment. Aussie dollar Swiss. I'm not trading the Swiss at the moment, as you know, if you've been in here for a while, but look at that exhaustion. So that 4-hour candle there is 146. So that's 2.5 ADR. Market shot. But it could well just continue to do that. We don't know. But, you know, hammers and shooting stars are probably the best candlestick pattern you can find. But the problem people have with them and why people hop away from this kind of price action trading is they don't happen very often. And when they do happen, they're unpredictable. And they also happen in the middle of trends and moves. So the ones that happen at the end of a move are the exhaustion moves. And this is what we're seeing this morning is potentially a lot of exhaustion moves. So if you're a long-term trader these are the things that you're watching for on your hourly and 4 hourly charts. Swing traders specifically, who are going to be holding positions for a month to 3 months, these are their gold dust. Yeah, these are signs that banks and institutions physically just cannot make that move continue. Therefore, they have to pull it back the other way. And as soon as they start to do that, everybody jumps on board, because every banking institution at the moment that is short on this, their P&L has dropped by 2 ADR in the last 4 hours. They were massively in profit there. They're now a lot less in profit. So they will start to take profit. As they start to take profit, other banks and institutions will see their P&Ls drop. They will start to take profit, which is why we get these big, fast, sharp profit take moves. The climbing the stairs, falling the elevator. This is the profit take. Or climbing down the stairs and taking the elevator up. It happens the same way, but more often than not, gravity helps. So the Swiss franc at the moment, again, bullish bias on this, but the Swiss franc, Jordan from the Swiss National Bank has come out on the last interest rate drop and said openly, we are going to manipulate our currency. They're not hiding it like the Japanese do. They've come out and said, we will manipulate this long or short as we see fit. It's also a safe haven currency. So if it does kick off in the Middle East, this thing's going to power out like a steam train. So this, yes, beautiful exhaustion move. 2 missiles fired from Libya actually hitting another country or anything like that, this thing's going down like a steam train, yeah? Because the Swiss franc is where all the money's going to go. If there's money left anywhere, that is. Yeah, everything's selling off like a loony, isn't it? But, so yeah, so this is a fundamental long, but the Swiss franc at the moment, very, very, very hard to trade. So I'll go through all the Swissies. They're all doing the same thing, as you can see. Big, strong moves in the Swiss franc at the moment, as you would expect. When the market goes into fear mode, we go into the Swiss. So whether or not these moves are going to, I mean, you can't look at that and say, yes, that's going to be sustained. I mean, it's never happened. So look at the RSI on this, on the 4 hour. We're down at 4.8. It's below 5. I mean, I don't know how far my charts go back. There we go. There's one. 2020, COVID. We haven't got COVID at the moment. Last time we had moves like this was COVID. And this is worse. Yeah. COVID, we got down to 5.6. We're below 5. This is not normal. Yeah. So, you know, and this is part of the analysis that I've been doing over the last 3 days when I got back from holiday. I'm looking at this scenario and I'm trying to find confluence in history. There isn't any. Yeah. So this sort of stuff is just not survivable. Yeah. You can't predict it. You can't trade it. If you're in it, you will have got out of it because you've been going, holy crap, I've made more money than I've ever made in my life. It's going to come back. If you were short on this move here, from here, or from anywhere, the first bull candle, you're going to crap your pants and you're going to close it. Yeah? Because you've got so much money there. Every move, every uptick, you're going to be watching it going, you close it. Yeah? People can't hold positions. They can't hold them. EAs can, people can't. Yeah? You will be taking this. If someone's waving 200 grand in front of you, or 100 grand, or 10 grand, or 5 grand, whatever it is they're waving in front of you, which is larger than you've had for a long time, you're taking it. Yeah. You'll be looking at it in monetary terms going, there's my car payment, there's my mortgage for the next 3 months. I'm taking it. You could have paid your mortgage for the whole year. But how would you know? You can't. Yeah, so you can't judge these moves as normal moves. The problem we've got is every ounce of most traders' bodies now is going to be doing that. Yeah. Institutional traders are going to be doing that, not because they want to buy it, because they've got to get out of the moves that they're in, because they've caused this. Yeah. So if it kicks off, and it can kick off, as we know, we've had rockets firing over the weekend. We've got evacuation orders happening. If it does kick off, the Swiss franc has only got one way to go, and that is to power up, because they will pull currency out of other currencies and put it into the Swiss as a safe haven. Also, the yen will benefit from the move as well. But was this an anticipatory purchase? And that is the move that we've seen in anticipation of what is starting to kick off in the Middle East or not. We don't know. Also, uncertainty with the US. Screw the US. I really don't know what they're doing. Let's just buy the Swiss and stick there until the US has decided what they're going to do. Was that the move? Yeah. No one knows. No one can tell you. There isn't any single central bank or institution that can tell you what's going on. They're all an amalgamation. All you're seeing on the chart here is an amalgamation of all the orders that they've all put together at once, executed. They just happen to be massively bearish on this and massively bullish on that at the same time. This can change. And the Swiss obviously have said that they can manipulate this when they want to. So if they don't like the fact that they are a very strong currency at the moment, they do not want to be in a strong currency position ahead of what is coming, they may well sell off a load of Swiss franc, in which case you're going to see everything pile up against the Swissy. Yeah, Jordan can press the button to execute that at any time. So any trades you have in the Swiss, you need to be careful. Or stop loss strategies on the Swiss really is all I would condone at the moment. You know, looking at where it's going to pull back to, you've got very obvious resistance zone sitting up here with monthly lows. Yeah, banks and institutions have limits set at monthly lows and highs. If it's coming back, that is a very obvious target. It could flag and continue. Yeah, we haven't seen a move like this before. Who's to say we're not going to see a move continue and embed down here for the next week, 2 weeks, 3 weeks, 4 weeks, whatever? Yeah, don't know. Impossible to predict. So there's all the Swissies, which brings me nicely onto the yen. Aussie yen. Again, the yen we know has had the biggest move of its life. We'll look at the US start in reverse order on the yens. So we know all about the US dollar yen. We've been watching the US dollar yen for intervention moves. They've happened. They've failed multiple times. This one stuck. They added to it the next day, literally the morning after the intervention went in this time. They added more volume. They put a second smaller move in, and then the following week they added more, and it hasn't stopped. Yeah, the market's got the message. We're going to buy the yen. At the same time as the US dollar decided to tell everyone that they're going to drop interest rates. Yeah, not just drop them. Maybe, 3 months ago I was talking about the Fed saying that they were going to drop it maybe by 0.25% if we can squeeze it in this year. Now we're up to 1.25 as a minimum by the end of the year. Yeah, it's a 1% change in months. So obviously this has fueled this move dramatically, but the climbing up the stairs, falling down the elevator shaft scenario that I talk about all the time doesn't do that justice. That's what I mean. Not that. This is, I'm not going to use it. I'm not going to use the word, but this is just not been seen before, is it? You've got a very strong triple bottom support coming up, which is basically where we are now. The market, it seems almost impossible for the market to continue this move. Who in their right mind is going to want to take the opposite side of one of these orders after this move? This has been rolled over multiple times. So this does look like a massive exhaustion move to me, but it looked like a massive exhaustion move there. It looked like a massive exhaustion move there. This is even bigger than those, and it looks like a massive exhaustion move here at support. So you've got confluence, even better. So the market's going to want to pull back on this. So you want to look at this whole move, actually look at the intervention move. So look at the move from here down to here. And you're going to be looking at a 38 to 50% retracement on that if we are going to remain in that direction. And the fundamentals, don't forget the Japanese are increasing interest rates. US are now cutting. So the fundamentals are definitely short on this. But trying to get in, this is why I was saying that right at the beginning of the stream, these conditions in the market, if you're a breakout trader, you are absolutely milking it at the moment. If you're a trend trader, you can't get in on this. You're not getting pullbacks. It's just about flagging. Yeah, there's no pullback. So that was a 38. Look, that's the best you've had on that. So, you know, where this goes back to, don't know. But if you're going to trade it, all these yens, you've got the fundamentals massively against you. You've got to be long in it. It's a carry trade long, which is good, which means you're going to get positive swaps out of it. But you need to be stopping out on this. If it doesn't do what you want, you need to be out. Yeah. Beautiful 3-bar reversal on the hourly just gone in. Look. Bear, pause, push. Yeah. There's an inside bar forming. So buyers and sellers both at equilibrium. There's only one place to go for me, which is 300% ADR up from where we are. But if it doesn't, do not try and position trade this. I've been out of the yen for many weeks now, and I've got no plans to get back into it. This thing is, as you can see, melting. So all yen pairs are exactly the same. What can you say? It's just an unbelievable move. It's not been seen before, not of this magnitude anyway. Typical intervention moves are 300 ADR, 500 ADR. This sell-off is, I don't even know how to count it. Unbelievable. 28,000 pips. Like 100 ADR. But anyway, so yens, I would love to think I could get in on a pullback on it, but I just can't find any reason to get in. They're all coming down to support. It's a beautiful long, but you've had many supports that have just completely failed. It hasn't even batted an eyelid. Yeah. So we wait and see what happens with them. But if you're going to trade the yens, it's got to be using a stop loss. There's no position trading opportunities on them. Market structure doesn't exist. Yeah, it's just a meltdown. So look at long term with all of these pairs, what we've been going through with the yen. So and look at that last pullback we had on that move. So that was the last intervention we had at 150. That's what happened after the intervention. Remember, every time I've talked about intervention, I've said we got a 50% retracement on the last intervention. We've got a 50% retracement on this intervention. Yeah. But the difference between that intervention and this intervention is the US dollar's stance on interest rates is negative now. So we are bearish. So where do you get into this? Impossible. There's no resistance to the upside to pick a path. Yeah. Forget that monthly low. It's almost like it doesn't exist. You've got a pause where the market tried to pull back there. Reason for that is because they used a lot of volume to get through there because there was limit orders sitting there wanting to buy the monthly low. They got run over, exhausted, had to pull back, gain more power and push down. So where on earth are you going to get in? It's got to be that propulsion move there on the daily. That's the only way I would want to get into a short on this. Longs, fine. But they're all the same. So, you know, what do you do with that? No, look at it and go, bleh. Aussie New Zealand. So the Aussie New Zealand obviously is at the moment it's a very difficult currency to call a bias on. We've got a long against a long. The fundamentals on both are long. Yeah, interest rates are not coming down at the moment. Inflation sticky, but coming down at a fairly decent rate. One of them is going to pull first. Whoever pulls first is going to lose. Yeah. So you could get this type of price action coming. Yeah. So be very, very careful with the Aussie New Zealand as well. All my back testing with RSI2 strategy that I've done has proven that it's very difficult to make money out of the Aussie New Zealand with mean reversion strategy, because although it does sit in a mean reversion state for the majority of the time, when it trends, because these guys are close trade partners, they're both commodity pairs as well. When it does trend, it doesn't stop. So it's very, very hard to get out of. The second largest loss I've ever had is on the Aussie New Zealand. So it's a tricky one. And in this current market climate, it's probably one you just want to kick out the portfolio for the moment or base a stop loss strategy on it. Yeah, so normal position trading, normal market reversal alert strategy, using stops, not a problem. Yeah. Support resistance. This is why the lines are on the chart for the weekly and monthly levels. Weekly and monthly levels is where market participants have limit orders. Yeah, watch those weekly, monthly levels, likely to get bounces on them. At the moment, the speed that this thing is moving, you can almost, the best thing to do, which is what the banks are doing and always have done, is to stop and reverse strategy. So if it pulls back up to the monthly low, short it. If it breaks through, flip long. Get out your short and flip long, or hedge it, whatever you want to do. But the market is coming alive. So it's a case of you're going to get a lot of erratic movement, especially as soon as one of these guys either says, we're going to drop the rates now, or potentially in the Aussies case, we just need 0.25% on it. That's going to take off. Yeah. But at the moment, there is no reason for it to do anything, especially that. Yeah. And again, another move which makes absolutely no sense. What was the last change on the New Zealand dollar interest rate? Nothing. Why on earth did it collapse then? Yeah. What was the last change there on the New Zealand dollar interest rate? Nothing. Why did it pump like that? Every time there's no interest rate change, the New Zealand dollar seems to be reacting absolutely crazy. Yeah. Market is just moving for the sake of moving. No logic based on fundamentals on this one. So hard one to call. Aussie US, again, it's a US pair. So all the US pairs at the moment, you've got to be looking to long everything against the US from a fundamental perspective, but from what the market is actually going to do with it perspective, difficult to call. So this move today, just, you have to ask the question, don't you? Do banks and institutions put these ridiculous moves in just to screw everybody's indicators? There is no indicator on the planet right now that is making any sense of its readings. Doesn't matter if it's a moving average. Doesn't matter if it's an oscillator. Doesn't matter if it's anything that draws an arrow on your chart or puts a line on your chart or draws this sort of thing. Doesn't make any difference. None of them are used to this price action. Therefore, all of them fail. Every indicator tells you what's happened in the past. Where's it going from here? Guaranteed that's going to happen. That's it. It's all you've got. There's no indicator that can tell you what to do now. So you've just got to be careful with everything US based as well. Don't forget, the US is the world's currency at the moment. So everything that moves is based on US dollar movement. Yeah. So when the US is the largest held currency, so when you have something happening to that, to make this move at the extent that it has, you have to extract money from the other currencies. Everything moves when the US dollar moves. Yeah. So these all look like very, very strong exhaustion moves that we've seen on the US at the moment, and especially love the fact that we are hitting all of these supports. It just begs for a long, doesn't it? But it's been begging for a long for quite a while. Yeah, look at the embedded RSI on the Aussie US here. Yeah, that entire period there, from there, has been looking for a long just to get some profit off the table. But the market conditions are just not playing ball at the moment. So Aussie US, CAD Swiss, I've covered the Swissies and the Yens. Euros. So again, Euro, bearish. Yeah, interest rates have dropped on the euro. We're down to 4.25%. We didn't change this time. So Lagarde has done exactly what she said. We are going to drop the interest rates. We are going to freeze the interest rates. We are going to see what happens, and then we will drop the interest rates and freeze the interest rates. That has changed. Okay, so traders are now factoring in a much steeper, faster drop on the euro than anticipated, mainly because we were forecasting, or Lagarde was forecasting, a bounce on CPI. He did, but not by what we were expecting. So the chances are that this could turn into that or that, which is going to come down too fast, which means they've got to get rid of that interest rate. So that will make it bearish. Bearish currencies go down. Euro not doing what it says on the tin either at the moment. So a lot of this movement that we're seeing doesn't match up with the institutional directional bias at the moment. So with this one, you've got a bear against a bull. Yeah, definitely doing that. But the volatility, this move here, no problem. Scale in, drop. Yeah, it's a pullback on a downward leg. Yeah, or rather, it was a pullback on a downward leg until the utter lunacy that we've been experiencing over the last 3 or 4 days, caused mainly by the Fed. We're out of these highs. And again, look at that level there. This is going back to July last year. So this is last year's high. We've tapped into last year's high. Limit orders will have triggered. So very high probability this is, again, an exhaustion move. But fundamentals are telling you you should be doing nothing but that at the moment. So this is why all the fundamental traders, if you go onto places like Forex Factory and stuff, which is, I would never do that. You'll lose your entire life. But if you go onto Forex Factory, you'll find now all the traders that are technical analysts, yeah. They call it fundamentals. Yeah, why would you? Doesn't matter what the fundamentals say. Your charts and your indicators are what's going to make you the money. They'll all be calling out now going, told you so. See, fundamentals make absolutely no sense. This is the first time in 20 years they've failed me. But yes, now they're not working. But you'll see them going mental on the forums at the moment saying, oh, fundamental analysis, what a load of rubbish. That shouldn't be going that way, should it? But my support and resistance and supply and demand indicator is telling me to sell. Anyway, sorry, I just spent a bit of time on Forex Factory last week. So it's reminded me why I left Forex Factory. I got sucked in for about half a day reading the crap, looking at the crap. After you've been trading for over 15 years, looking at some of the people that are starting to trade now, getting sucked into that thing, you just want to pull them out and go, don't use the internet. You can't. Oil is down because oil and copper is down. Yeah. Well, oil isn't down. Oil is caused by the US dollar. Oil isn't down. Oil's not doing anything at the moment. Oil is in contraction. But you look at the move on oil. Yeah. And look at the move on the odd. Not because of oil. Copper is down as well, but obviously commodity pairs are affected by commodities. Yeah. So if you're trading the commodity pairs, you're trading the equivalent of the commodities. They export more sheep than anybody else, actually. So that's New Zealand. Sorry, New Zealand export more sheep. So Euro odd again, fundamentally accelerated sells on euro because of potential more. We need Lagarde to confirm all this, but more interest rate drops potentially than we were expecting. Aussie not doing that, so therefore the fundamentals are down. Why then do we do this? Again, I don't think we'll get an answer for that. It's just panic buying and selling and basically pulling money out. Don't forget, the vast majority of every single one of these candlesticks is a bank or institutional move over a long-term period. So when your portfolio needs adjusting, you adjust it. That is likely what's happening. Let's not stay in FX for the moment because we've got a lot of volatility coming. Let's stick it all in whatever. Yeah, it doesn't matter what it's in. Your portfolio is made up of FX, stocks, indices, commodities, bonds, all sorts of stuff. So when you see these big movements, it's just basically money being pulled out of or pushed into something because it's being changed. The risk is being changed, which is why we have this risk off, risk on type saying. So highly likely we're going to get a massive pullback on this. But you can't use ADR to measure this. So you've got to look visually for where this is going to. You've got a weekly high and last month's high there. So you're going to find all the breakout traders will be adding to their positions there. All the breakout traders that are taking profit will continue to take profit. Yeah, if you want to buy this breakout, do that. But you're buying something that's dropping interest rates against something that is not dropping interest rates. For me, this is a sell and hold as long as you can. Euro CAD. Same thing. Again, euro, big move up, but this isn't caused by the euro. This is caused by the US dollar and Canadian collapse. Yeah. So again, remember, there's always two instruments at play. Because this is flown up, everyone's going, why is the euro pumping? You can't say it's the euro pumping. You have to look at all the other euro pairs to confirm that. That's not pumping, is it? That is. That's not. That is. That is a little bit. Yeah. So when you look at these moves, you have to look at what's causing it. Is the Canadian causing it, or is the euro causing it? In this case, we seem to have some unwarranted euro strength coming in at the same time as the US dollar and the CAD are jumping ship. So again, exhaustion, huge breakout. But look at this chart on the 4 hour. Yeah. And look at the size of that move over the last few days. And what happens, I mean, it's quite hard to find that sort of movement because it's not often it happens. Maybe that there, potentially. Yeah. But this is why these are, I'm referring to these as potential exhaustion moves. After they've gone in, the market often will go into shock and it won't be able to do anything because it's like, right, we need to adjust. All portfolios after moves like this need to be adjusted. So it will either go into shock or it will correct. If it corrects, it will do that. If it goes into shock, it will accumulate. And the accumulation will usually end in a correction anyway. So either way, when you get these types of moves, but you can't use normal indicators to measure this because it's an outlier. It's an abnormal thing. So again, shorts on it. The bias is short. The bias on this one is actually a short against a short. Don't forget the CAD went first with interest rates followed by the euro. So these two guys are the shorters. A short against a short equals a range. Yeah, most of the time. So looks like a good short. Euro Swiss, again, I've done the Swissies. Euro pound. So this is the pound interest rate drop, obviously weakening the pound. The euro is also dropping interest rates. But at the moment, you would usually expect when we've got interest rate drop against interest rate drop on the euro pound for the euro pound to drop. So the pound is the dominant currency, mainly because it's service industry and banking based, and that's what everything is that we're looking at. Tourism, mainly for Europe, but and cars. But yeah, I mean the bias is a short on this one. So again, we don't get up there. It's just not something we have seen. Okay, yeah. Here, this is COVID again. Look, oh no, this is Liz Truss. So this is Liz Truss announcing that actually we're not going to do everything we do with our finances in the same way as we've done for the last 200 years. We're going to do it different. And this is Bailey basically bailing Liz Truss out. These are the normal extensions you get above these levels. It's something like a worldwide pandemic we've never seen, or a decision coming out of the blue from some idiot who we've put in government that has not consulted anybody about what the potential impact could be. Yeah, black swans. Yeah, this is just the market reacting, and there's no news behind this. So it's typically a news spike that causes this sort of thing. So you've got to look at it and go, there is no way I'm buying this. It's got to be a mean reversion from it. But until we get confirmation, because we've got no confirmation as to why it's happened, we need to look at what the potential next move is going to be. So fundamentally, you shouldn't be doing that. But then again, you shouldn't be doing that, should it? So we'll have to wait and see. Just let that calm down for a bit. Euro New Zealand, pretty much undone that move. So there's your yearly high sell order, limit orders triggering. I mean, this is obviously just a parabolic move. Again, already exhausted 50% of the move plus. Look at that RSI move, look. I don't think I've ever seen that on a chart. Yeah, it's unprecedented. So we've already retraced more than 50% of this 4 hour candle. If this closes below that level, the entire universe is going to be seeing this as an exhaustion move and a failed breakout, and they're going to short the crap out of it. Yeah. So there is nobody left to go long up there. There are only sellers available now in the market. So we'll have to wait and see if there's any more reason to come back and buy this euro. If Lagarde comes out and says, I don't know what you're talking about, dropping interest rates faster, we're going to go pause, drop at 0.25%, the same as before. Bullish. Yeah. Other than that, there's no reason why that shouldn't come down. Euro, US dollar. Again, this US dollar move, crazy. But anyway, the euro is coming up into a lovely resistance area here. So we've sold this area multiple times after the drop. So we're going to find sellers here that are looking to short the market. It's in a beautiful range at the moment. We've just got up here a lot quicker than anticipated, but that doesn't mean the orders are going to be pulled that would be sitting up here. So again, extended to the upside. The difficulty with the euro US dollar specifically is they are both big bear fundamentals now. The US dollar typically will be the faster mover of the two. So there is potential, I think, for this to continue, but it's going to need, I think, to pull back before it does that. So we'll have to wait and see what happens with that one. The pound, again, pound is bearish because they're dropping interest rates. Australian dollar is not. This is exactly the same analysis as the euros against the Australians. The fundamentals are short. This looks like exhaustion, but how they've caused that, I don't know. But again, these levels that we got prior here, look, we're up at the 93s. I said back here, this is a level we've not been at before. We got a bit of a pullback from it. We attempted to take that weekly high out. We failed again, and now they've screamed through. So I haven't seen moves like this before, personally. So I have no idea if they're going to continue that move. But certainly from a fundamental perspective, you won't be seeing the market analyzing it, going, yes, you should be buying the pound at the moment. They're dropping their interest rates. So again, limits at yearly highs. We're hitting yearly highs and we're rejecting these yearly highs. It's almost like they've pushed many of these pairs up to these yearly highs to test these levels and are finding out whether or not, yes, we do want to be doing what we were doing last year. Don't forget, this point last year or just beyond was the point we stopped interest rate rallies. So we went from COVID to interest rate rallies to over 12 months of interest rate pause. This is where interest rate pause started. Now we're going into interest rate drop. So it makes total sense for this to be a long-term double top, but need to confirm it. Again, reverse alert. This is what the market reverse alert indicator is designed to show you. When you get that reversal, if it holds and you make a new high, that is your W. If this, I mean, it's got a long way to go to reverse on the hourly, but if that breaks and holds, there is your M pattern reversal at an annual high. You could hold that for the year. Yeah, because we're not going to stop dropping interest rates when we start, unless obviously inflation bounces. You never know. So, but getting an entry is the hard part. 15-minute, you've had one this morning. No, you haven't even. You haven't even had a 15-minute this morning. Look. 15-minute and the hourly are in the same spot. You know, look how far this thing's got to drop just to get a reversal of that. It's ridiculous, isn't it? But that high, you know, any stop loss strategy, if it breaks that high, you don't want to be in it. So give yourself a quarter of an ADR above that, short it, go away for a year and come back. You'll probably be absolutely fine. But, you know, these are long-term strategies. That's not what we're really looking to do. Pound CAD. So looking at the pound CAD, we've got obviously a very large correctional move going in again. So the bias on this is a short against a short. There is no real reason to be buying or selling this. Where's that fib come from? Let me just get rid of that a minute. It's popping up. It's just an old fib I've left on the chart from ages ago. So we got plenty of obviously reason to have been buying the pound against the Canadian for the last few months. Right now, though, we've got the interest rate drop coming in. As you can see, we've got a lovely reversal going in. We're pulling back into what should be a continuation short. But this is a short against a short, so it can go both ways. In theory, you can trade this in any direction. Yeah. So it's just a case of waiting for a signal. But this, I wouldn't say necessarily this week, but for the next few days, you kind of want to just wait for it to settle and see what the market is making of this. I suspect if they do test the highs, we'll probably hold this level. This is just some weird knee-jerk shakeout that's going on at the minute. Pound Swiss, I've covered that one already, and the pound yen. Pound New Zealand, very much the same as the pound odd. Basically, we should be looking for short continuations. So this is exactly where you would be selling it in the pullback to go short. So yeah, looks good for shorts. If you got into it on the extension down here, hopefully you're out. If you got into it, the extension on there, you're out on that. So I got out of the pound New Zealand. I got out of the pound New Zealand last week. I took it off. When did I take this off? Last day, holiday. Tuesday, last week. Tuesday? Where's my day separators gone? Where are we? Monday, Friday, Thursday, Wednesday, Tuesday, Wednesday, Tuesday. It was Tuesday. It was Tuesday evening here. Yeah. I had aggressive drawdown control positions on this, and I got out here. Then it obviously collapsed. I was on a plane, couldn't do anything about it, and recovering from jet lag. And then it's continued down. So, you know, the pullback, like I said, always looking for 38 to 50% retracement. It gave exactly that. 50. I got out at the 23. Actually, I got out before the 23 because it was just too long and I've come back from holiday and I just wanted out, basically. So it should have held it, really. Would have been a lovely payout. But, yeah, continuation short. Pound is bearish, New Zealand is bullish. Yeah, but these moves that we're getting from this New Zealand dollar interest rate change are just ridiculous, illogical moves. Every time we get the New Zealand dollar not changing their interest rates, it's almost like the market has factored in the opposite. It hasn't. Market's done nothing. Yeah, it suddenly takes off when the New Zealand dollar interest rate change doesn't happen. It's bizarre. But yeah, so for me, continuation shorts on the pound, unless something happens fundamentally over the last next couple of weeks, i.e. we suddenly go, do you know what, Israel, we'll come and fight with you. Then what's going to happen to the pound? We don't know, do we? So just got to play it by ear with the fundamentals and what's going on in the world at the moment. Pound US dollar, this is a bear against a bear. Again, you will find that the US dollar will be the fastest, strongest mover of the two. So what we're looking for is how quick is that US dollar going to drop? In which case, if it drops at a similar rate to the pound, we're just going to see ourselves going back into normal conditions. There is very little reason for this to do much more than that. But we'll have to wait and see. So just going to give it a few days to sort its life out. But again, this is an exhaustion, potentially exhaustion move. Not coincidental that they buy up these levels. It's just what the market does. It has orders placed at the levels to get in and out. Big round numbers as well is what the market likes to pay attention to. So New Zealand dollars, again, fundamentals for the New Zealand dollar are bullish. Canadian dollar are bearish. This is a long, so that is where you wanted to buy up the next leg up. But again, you wouldn't, if you're using, and this is part of the problem with any kind of indicator-based strategy, if you're using the market reversal alerts indicator, for example, when my chart changes, you know, trying to get a signal on a move like this is very, very, very difficult because the move is so big and so extended. By the time the candlesticks are closed, there's no signal produced. It's all moved too far. The move is almost played out. So if you're trading hourly charts, yeah, within 3 hours, You've done a move of 225% of the normal range of movement and retraced it by over 50%. Yeah, you're asleep. Yeah, so there's no real easy way of getting in, but pullback traders will have limit orders placed. Banks and institutions will have limit orders placed to add to their positions in what we would normally call propulsion gaps, but there isn't any in this particular case. But there will be short orders placed in there for any of the sellers if they're there, but I think that will probably get run over and continue. So New Zealand dollar long, CAD short, Swiss I've covered, yen I've covered, New Zealand US, same as the New Zealand dollar CAD. Same bias, New Zealand long, US short. This should be rallying from a fundamental perspective. Long term, we've just double bottomed and we've just retested the double bottom. So you've got another little support coming up there. So this one isn't actually as bad as from a position trading perspective. Long in this now is fundamentally correct. Adding into it down to there, you're probably looking at adding 2 or 3 positions on this just one candlestick. So bear in mind, if you were to come and look for a retest of the lows from last year, you're looking basically at 3, possibly 6 positions by the time you get down into there because of what's been caused by this move today. And that's what I'm saying, is probably better just to sit on your hands for a week and just see what this market does. Let it decide, I am going with fundamental bias or not, and then look for opportunities to jump on. US dollar CAD, same thing. Absolutely no reason why we should have any kind of bias other than range bound on this. This is how the US dollar CAD works. They are close trade partners. They both export an awful lot of oil. They both have terrible unemployment. Their interest rates are too high. Canadians are dropping their interest rates down. The inflation's too high. This is why we've had this scenario. I've made an absolute fortune out of this in the last quarter, just by basically saying every time you get up there, short it, and every time you get down there, long it. Brilliant. Not anymore. It's just taken off. But there's no reason why it shouldn't continue this, because now we've got confirmation of the bias being bear against a bear is a sideways move. So we'll see. But again, look at this RSI on this one. 4.7 US dollar Swiss, mental. Swiss franc. So yeah, US dollar CAD. You should be able to trade that in both directions at the moment. That's a beautiful move. Look at that. So 100% retracement on this morning's move. Already done on that one. Absolutely no reason for that US dollar strength whatsoever there. And that's it from the pairs. Oil, I just bought oil up this morning because I wanted to have a look at oil and gold to see what... just to get confirmation on what the hell is going on in the market. So when you see an awful lot of movement like we've had this morning, to figure out why it's moving and what is actually moving, if you look at the commodities, they will give you an indication. If all the commodities have gone completely the opposite direction to what the US dollar's done, you can say for sure that's a US dollar move. Not the case today. Yeah. So this is just some kind of chaotic liquidity squeeze going on this morning because there isn't any there. We're in summer trading. Yeah. Remember I said before I went on holiday, we've had a really quiet contracted period. We've had some really strong squeezes that make no fundamental sense. And now we're going into summer trading. I might as well take the summer off. Things like this happen because there's no liquidity in the market. So the market gets squeezed further and faster because it's got to get those orders filled. Don't forget, half of the orders placed by banks and institutions are commercial orders. So if Microsoft say they need to convert an absolute ton of US dollar into Swiss franc, they have to place the order. If there's nobody on the other side of the order and Microsoft want it placed within the next 24 hours, you've got to go and find someone that's going to buy your order. And if that person that would normally sit there is there because these guys are all on holiday, you ain't going to get it. You have to get the worst possible price. You get more slippage. Spreads will become wider as well, or probably are already wider. I haven't really looked at it. I haven't had time to look at anything this morning. Just been watching what's been unfolding before I even came on. So indices wise, we've got time's the FTSE this morning? Could have sworn I left a trade on the FTSE short this morning. I'll look at that in a minute. So indices wise, I'm not going to trade the US indices this afternoon. I mean, you can see the NASDAQ has dropped already 200% of ADR today and recovered 100% of that movement. The Dow almost tapped ADR, and the S&P 150% of ADR, and it's pulled back half of that move as well. So the indices, obviously, the Globex session immediately sold off those indices this morning as well. So market, it was almost like the market is just waiting this morning. We've got to get these orders moved, yeah. And it's probably caused by what's been going on with the missile launches over the weekend. So this, to me, looks like it is just a shifting of risk, which will unshift itself typically, and then fall back in line with what should be going on. But when the market's done, you know, sort of 100 and 200% of its normal movement before the market opens at the opening bell, you've got to ask if there's going to be any liquidity there. So from this particular strategy from SIH, because you're hedging, there's a high probability of a hedge. If the market has done its liquidity, it's going to range. If it's going to range, it's going to hedge you. So not going to trade this afternoon on this. For opening range breakout strategy, if you're going to use the stop-based version, not really a problem. If it goes, brilliant. If it doesn't, no problem. So, but bear in mind, there is the possibility with ORB of, if it goes into range, you end up just going long, short, long, short, long, short, and never hit a target. So it's, like I say, I've been through situations like this before where the market has just gone nuts for virtually not for no reason. It obviously goes nuts for a reason, but if you can't fathom why and what the potential moves after it are, it's way better to sit on your hands. Like I said, long, short, and flat. Those are the three positions. Flat is nothing wrong with it. There's nothing wrong with sitting there and going, I don't know what to do. Wait for a week. Wait for a day. Wait for whatever you want to, but don't get in because, yeah. If you've got a plan and you think, yeah, what Lee's saying sounds logical, this looks like an exhaustion move, there's a high probability of a pullback, do it. But have a plan. What are you going to do if it isn't? What if this candle here is the pause candle before the next bear candle? What are you going to do? Are you going to stop out? And if you're not going to stop out and you're going to try and position trade this extension, where are you getting into your next trades? Are you going to get in normally at 1 ADR apart, half an ADR apart, or because the next support isn't all the way down to there, are you going to get in 2 ADR apart on this particular case? You can adjust the EA to do all of this instantly. So think about your trades. Don't trade normally. This is not normal. You have to adapt. This is why EAs and strategies and traders fail. You've got to adapt to these market conditions. The market does not stay in the same condition all the time, which is why strategies do not work all the time. Yeah. When the market's doing this, you need to adapt. And your adaptation is either not doing anything or making bigger, wider moves. This is why we use ADR. If the market is moving way beyond its normal ADRs for days on end, you cannot use normal ADR. You've got to use extended ADR measurements. Yeah. So they will sort themselves out after 10 days if you're using ADR 10. Another option is to move your ADR down to ADR 5 so it adapts quicker. Yeah. But again, this is the sort of stuff you have to do yourself as a trader. You can't rely on automation for everything. So that's all the analysis done this morning. Let me just catch up on the chat. I'm going to have a quick look through my research that I've been doing. Conspiracy to destroy indicators. Yeah. I used to be in the conspiracy crowd. When you start trading, you have this mentality that the market is against you. And it takes quite a long time to shake that for a lot of people. Me, it did. It was like, Why is it every time the market moves down and every time I buy it, it goes the opposite way? And then when I do the opposite to what I did, it does the opposite to what I thought it was going to do. And it's like every time I do something, they know. Yeah. These moves screw up all the indicators. My strategy is not working anymore. It's nothing to do with your strategy. Your strategy is based on indicators. Indicators are a reading of price. Price has done something abnormal. Therefore, your strategy is going to do something abnormal. Yeah. Oh, the strategy doesn't work. I'm going to find one that works better in this type of condition. Well, this type of condition is finished now. We're going back to the condition you just had that the strategy would have worked on. Oh, well, I'll hop back to that one again. Oh, now the market's gone nuts again. That's your cycle, isn't it? That's what people do. So you've just got to adapt basically to what you're seeing, which most of the time means not doing anything. But we'll have to wait and see what happens. But the conspiracy theory, you'll find a lot of them out there now. Suddenly going, is the market just basically running everybody's stops? They don't even know you exist. The market has done this because the market needed to do this. They don't know you are there. I've said this in the live rooms before. I was in a trading group of a good couple of hundred people trading exactly the same strategy for a while. We all hit the button at the same time on the same instrument with a decent amount of lot size. It didn't tick. Yeah, you are insignificant. There is no amount of money that you, with your personal wealth and everybody you know's personal wealth, can put into this market to make it even tick. It's a $7 trillion a day market. When it wants to move, it moves. You just have to go with it. You are on a train. It is going to go somewhere. If it goes the wrong direction, you've got to deal with it. All there is. What do you think about the chances of euro odd coming way back down below these MAs? Well, I mean, first of all, it's never been that far away from a moving average before. So what do I think the chances are? Huge. It's already done it. I mean, it's already on its way. Look, we're down below last year's high. An hour ago, we were way above last year's high. We've put in 1.5 ADR in the last hour. Below the moving averages, I mean, fundamentally, yes. Definitely. The euro is reducing interest rates. The Australian dollar isn't. However, whenever you analyze anything, and this is why markets work. Whenever you analyze anything, whether it be me, whether it be anybody out there, whether it be you, whatever, all you're doing is giving your opinion on something. Yeah, my opinion is based on my 15 plus years experience doing this, and what I've seen happen and what I can see on my charts. I've never seen anything like this. I can give you my opinion. The fact that when the market gets extended, it usually pulls back. My entire methodology is based on bank movement. Banks push, they profit take. The banks push, they profit take. They push, they profit take. What's that? Push. I can't say anything but that, because that's what I've been doing all my life. But I've never seen this much. So I don't know. The ECB have told us that they're dropping interest rates. So that's bearish. The Aussies have told us they're not dropping interest rates. That's bullish. The bias on this is short. The bias on it was short here. This was a beautiful pullback entry until this happened. But why has this happened? What impact is this going to have on institutional positioning? We don't know. Don't forget, the market moves based on banks making money. The whole mechanism of the foreign exchange market is manipulation. It is banks moving in one direction and moving back the other direction to profit. There are banks and institutions offside on this who will be pushing like you've never seen before to get back on side, to get out. Yeah. This is the whole premise of market structure, is bank and institutional profit take and movement. The banks and institutions cannot add more there, because the banks and institutions need, either from a profit perspective or from a break-even achievement perspective, to be doing the opposite to what's just happened. But the fundamentals are that. However, until the banks and institutions are at the playing field they want to be at, they can do what the hell they like with this. Yeah. So yes, fundamentally, this needs to come down. But for the next month, it could do that. And then they'll pull it down for 2 months after that. Don't forget, things like COT and these moving averages that you see on the chart. These are monthly and quarterly moving averages. Banks and institutions move in monthly and quarterly cycles. Reporting is monthly and quarterly cycles. Profit take is monthly and quarterly cycles. Commissions are monthly and quarterly. Everything moves in 24 and 72-day movement cycles. So just because it needs to do this from a fundamental perspective doesn't mean that they can't do that before they do that. But look at it. I mean, if you're a bank and you sold last year's low and you're short bias, you've just sold last year's low again. Where's it going next? Below that low. We get these big V shapes and A shapes. I talk about these all the time. Yeah. And this is the difficult part of trading. I talk about the theory all the time and I demonstrate the theory all the time. I show you it in the live room all the time. Yeah. All the time. The V shape, the A shape recovery. I don't know if it's going to do that A shape recovery this time. But if it does, that's what's going to happen. Your job is to plan for the trade. And if the trade plan works, take the money. If the trade plan doesn't work, execute a backup plan. That is what trading is all about. It's not about getting it right. It's about thinking what could happen next. You've got to, it's like chess. You've got to have 3 or 4 plays ready to go. If he does that, I'm going to do that, or I'm going to do that. And if I do that or that, his options are that, that, or that. And if he does that one, I'm going to do that or that. That one, I'm going to do that or that. That's how chess players work. You are 10 steps ahead all the time. With trading, it's the same thing. This and all the smart money concept traders now are going, look at the stop run. They've run all the retail traders' stops. There's no retail traders there. They don't even know you exist. This is not caused by that. It's caused by the Bank of America, or rather the Fed, basically saying, this is what we're going to do next. And the market overreacting to it and slipping. Yeah. That plan, if you're a smart money trader now, is to short it with a stop loss there. Right? Your plan as a position trader is to short it there with a second entry and a third entry there. So if it does an uneven M pattern reversal, you are getting in there and there as well as the first entry. That's your plan, and you're planning for the A-shaped recovery. If the A-shaped recovery doesn't work out, you're planning for the pullback into the 2472. Yeah? You're planning what you might think is going to happen based on historical information. This hasn't happened in this strength before, so it's difficult to give any kind of prediction on anything, but that's my analysis. It's exhausted and it's going to need to do that before it does that, if it wants to do that. Nobody knows. You have risk. That's it. So you risk. You plan your risk. That's all you can do. The market will do what the market does. You have no control over that. You get on the train at one station. You want it to go to that station. If it goes to that station, you get off, you get on again at that station, and you want it to go to that station. If it goes to the next station, you get off, you get on again, you wait for it to go to the station. It will go to the station you want it to at some point. Your job is to stay on the train long enough to get off at the right place. All you can do. So fundamentally, yeah. Look at this. If let's take today out of the equation. In fact, let's do this. All right. So let's say we're talking about this on Friday. What have we got? High, low, lower high, lower low, lower high, lower low, double top, lower high. If you were looking at this on Friday, what would you be doing right now? selling the crap out of it. What would your plan be? Well, I get in here and I'm going to get out on a lower low, or in case it does that, I'm going to get out at 50% retracement or something like that. But if it continues up, I will be scaling in, hoping we get a double top there or a double top there. That's your plan on Friday. This is the condition of the market today. Your plan changed? No, you got in on Friday. You will have scaled in probably 2 or 3 times. You'll be in 4 or 5 positions now. You were only in 1 on Friday and it was in profit. Today, because of this, you're in 5 positions in drawdown. Probably taking some drawdown control possibly as well. But has your plan changed? Because once the market pushes up, it pulls back. All you've got. So whether it gets down below there, I do not know. What could be the next target for pound yen? I haven't really been looking at the target where? What do you mean target? Target long or target short? Can't answer that one. Morning, New George. Robinhood platform halted trading due to market meltdown. Yeah. Take a cruise next time. Yes. So I may well. It's probably what I'll be able to afford. The man with no face is watching your trades. Yes. Have the ECB confirmed a September rate cut? I can't remember. I did keep up with. I checked Financial Juice every morning and every evening while I was on holiday. I can't remember what traders. I mean, this morning, if you look at this morning's news, markets expect more than 90 basis points further ECB cuts this year, up from around 70. So we were looking at 3 further. They're now edging more towards 4. So Lagarde hasn't confirmed anything, but the futures market is forecasting a slightly more bearish move on the euro. Again, this is what I'm saying. This is when you look at the moves we've got. The euro pounds just hit its weekly range. Look at these moves we've got continuing. If they're dropping interest rates by 1%, we're in August, September, October, November, December. If they're going to drop by 1% by the end of the year, Lagarde has confirmed they're going in 0.25% increments. That is 1 interest rate drop every month for the rest of this year. Would you buy the euro if that was the plan? What's that? Completely nonsensical, this movement based on fundamentals. But traders, and I say traders as in institution, banks, institutions, pension funds, hedge funds, they use a scorecarding system to decide what their bank's stance should be on a currency. They will be long-term bullish or bearish or neutral. That is all there is. There is no scorecarding system in banks and institutions at the moment that will be saying buy the crap out of the euro because they're dropping interest rates. That isn't how fundamentals in economics works. They have technical analysts that look at risk models, quants, where they extract money out of market movement. They won't be looking at this in a normal way. So what you will find is that all the banks and institutions at the moment, like Franco said, Robinhood stopped trading. Banks and institutions will be way offside on either profit or drawdown based on the movements that have been caused by their peers. The advantage banks and institutions have is they can do what the hell they like. If Barclays really want this down by 200 ADR today, they have the power to do it. But to do that, need HSBC and Citibank to go into drawdown on their positions. So when you get these moves that are off the charts like this against fundamentals, banks and institutions will be recalculating what they need to do to get themselves back to level playing fields. And they have to try and achieve that with the help of the other banks and institutions, which is why we say this is all manipulated. This is why market makers exist. HSBC will be on the phone to Barclays saying, I've got X to execute on this. What have you got? I've got Y. Okay, can you make me a market up here so that I can get these executed? When you need yours done, we will do the same. We will make the market in the opposite direction. They will allocate funds for this. It's all organized. Banks do not lose money. Yeah, their job is to use your money to make money. They use interest rates as part of that mechanism. So this will all correct in some shape or form. The distance of correction and how long the correction takes is as long as they need to get it done, but it will get done. You just don't know when. This is the problem. And this is why everybody's systems and strategies fail, because the market has no interest in a resistance level on a line or a channel or a moving average or an oscillator or an arrow being drawn on your chart. It's irrelevant. If their books are long, they will push it. If their books are short, they will drop it. That's it. They haven't got a monkey. They don't care about indicators. Nothing. It doesn't make any difference. The reason Fibonacci is a self-fulfilling prophecy is because banks and institutions execute a percentage of orders long. They take a percentage off because the commercial hedges that they've put on long stay on. The speculative orders get taken off and put in the bank. That's why it pulls back and then it goes on that way again, because the commercials are long. The speculators are short at that particular time. It's just the way it works. So this will all correct. But timing, go back to the boot camp. What's the one thing as traders we will never be able to tell when something's going to happen? You can't. Timing is impossible. You have positioning. That's it. You are net long, net short, or flat. Your size of net long, short, or flat is risk. You're in control of risk. That's it. Nothing else. Doesn't matter what you do. There are indicators and there are strategies that will play out X% of the time, Y% of the time. Don't work. Nothing you can do. You have to sit through them. But the problem is, as soon as that happens, if you jump ship and go to the next strategy, you've just wasted however long you've spent learning how to do that. And it will work because it has worked. That's why it's been done. The hopping thing is what kills everybody. But, we've just got to basically sit through the pain. So the September rate drop, it's going to happen, I think. So is the US, so is the pound. They're all. This is why we're seeing this volatility. Don't forget, for 12 months we've been doing this, haven't we? ADRs at the lowest ever possible because the market's been going, what are you doing with interest rates? Don't know. What are you doing? Don't know. You're doing that? Yeah? Oh, no, you're not. You're doing that? Oh, no, you're not. What are you doing? What are you doing? Now we've got confirmation everybody's doing something. It's like, all right, here we go. Now we can make some money. But announcing it at the start of summer trading is just not helpful, is it? What can you do? Timing. Glad to have you back, especially for this insanity. Yeah. Don't expect me to shed any light on it, though, for you. I'm as in the dark as everybody on the planet, basically. When you look at dashboards and they look like that, you can't do anything with that information. That information tells me one thing: stay out. That's not normal. Not normal at all. Don't forget, it's Monday, yeah? It's Monday and the first full trading week of the month. How many times have we sat there and gone, oh, nothing's hit its monthly range yet this month? It's the last week of the month. Maybe we'll get a monthly range hit. If we do, it'll be a great opportunity to get in. We're 5 days in to this month. We've had, 3 trading days. We're at 175% of what we normally do in 1 month. This is just not normal. So there's a massive money-making opportunity, but there's a massive risk opportunity as well. Yeah. So don't forget, to make money, you have to have risk. That is what your account is there for. It's there to be used as drawdown. But don't get greedy. The Aussie rate is getting announced tomorrow morning, and it's not going to change. That should really get the euro odd down. Yep, I totally agree. I mean, in theory, yes, it should. But that's not bearish Australian dollar. It's neutral, isn't it? So it could go either way. Shouldn't go anyway. It should only go that way. If they surprise us and put the rate up, we're dead. No, well, if you're short on the euro odd, you're not dead. You're making a lot of money, because if they put the interest rate up on the Australian dollar, euro odd is going to collapse, because the Aussie will rally like crazy, which means the euro odd will come down fast. So if you're short on this and they put the rate up, what you want, if you're short on this, is you want them to unexpectedly increase interest rates tomorrow. That'll come down like a rock. They're not going to do that. Well, you say they're not going to do that. You know, we look how many times we've had a shock from the Aussies. Yeah. So going back to when we paused interest rates, which was they paused a little bit late, didn't they? They were a little bit later than the rest. Most of them paused interest rates July. So on the rally from COVID, we had 2 unexpected rate changes, and then after we got to kind of the pause scenario, they told us they were putting them up and didn't. Other than that, they are pretty rock solid. So it's unusual to get an unexpected change out of the Australians. But, you know, this is the difficulty, isn't it? Everybody, when they're looking for strategy development, backtesting, system engineering, everything, they're looking for regular norms. Anything outside of those norms is what mean reversion traders use for their criteria. Same with banks and institutions, interest rate norms, inflation change norms, unemployment norms. You've just had a move in the market. Certainly isn't normal. Yeah, this isn't normal at the moment. None of this is normal at the moment, is it? So what happens tomorrow could be a break from the norm. Yeah, the Australians have just seen their currency without interest rate change dropping dramatically. Yeah. In what should be, or what should be classed as fundamentally a bullish period for them. It's not been. So they may decide to make a change. I don't know. I very much doubt it. But their inflation is, I mean, it's stickier than everybody. Look at inflation now. That they've got the highest inflation figure out of the G7. So, and it's bounced last month. So, I don't know. Could be. That would be beautiful if anybody's short it. So just quickly before I go, because I've been waffling now for 2 hours. I got back from holiday last Tuesday. I spent Wednesday basically going like a zombie. But I did some research on Wednesday, and I did the coding for the EA. Surprised that actually worked. But I did the coding for the EA on Wednesday as well. And Thursday, Friday, I spent basically doing analysis into this situation that we've had over these moves over the last couple of weeks. Basically from a am I doing anything wrong perspective? Because obviously when you get these sorts of moves which create losses, you have to analyze them and think, right, why has that happened? Because it's not happened before. Yeah, this is the biggest down month I've had in 5.5 odd years. So when it happens, you look at it and go, right, what's changed? What's gone wrong? Because as I said, markets change, things change. One of the things I changed when the market contracted after the interest rate rallies was I switched from the RSI 4 hour to the RSI 1 hour. So I switched my strategy time frame from 4 hour to 1 hour. Reason being, we weren't getting signals on the 4 hour because the market contracted, the relative strength and the relative movement was reduced. So I was sitting there for weeks on end going, are we ever going to take a trade? So we had to adjust and adapt, which is what you have to do as a trader. You've got to be able to change your approach with what the market conditions are doing. So as we got contracted ADRs, switched down to the hourly time frame, which gave us more opportunities and more entry. With more opportunities and more entries comes more risk. And when you put risk on a lower time frame, that risk can be exponentially increased 4 times faster. So if you're trading the 4 hour charts, you get 4 hours of movement in one candlestick, giving you one signal. When you break down into the 1 hour time frame, you get 4 potential signals within that 4 hour candlestick, which is why lower time frame trading is much more risky and much less reliable than 4 hour and daily, which is what the institutions are all using. So I've done analysis, and the main reason I've taken the loss that I've taken is because of the, first of all, overexposure. My fault. I got overexposed, which means I had more risk on, double the risk that I should have done on 2 of the currencies which squeezed. We've got more squeezes, and because we've got more squeezes, trading on the hourly time frame, you get into the squeeze earlier. So, for example, on a 4 hour time frame, if I'm trading an 80 extension, I'd have got in there. Draw a line on the chart. If I was trading the 1 hour time frame, I would have got in there. Yeah, so you get in there, you're taking a trade, you're actually taking probably 2 to 3 trades entering on the hourly time frame before you would take your first trade on the 4 hour, and vice versa. Go up to daily time frame, you know. So what you're doing is getting into squeeze moves earlier, faster, which costs you more money. So I traded 4 hour, which is what the Bootcamp is taught on, H4M15 strategy, which was my bread and butter for many, many years. That switched. So what I've done is just a reanalysis of the strategy, and you know, these conditions are just not what we've had before. There's nothing you can do about them. They're abnormal. You can't prepare for them. You can't test for them because they've never been seen. So it's just one of those scenarios which, in the 10, 15 years of backtesting that I've done on the strategy before I developed and started trading the strategy, I can't test it because it didn't happen. So as you can see on the chart here, as an example, where these RSI levels are, we haven't had them. Yeah, and you can go back as long as you like. It's incredibly rare to get anywhere near these levels. So these moves are just parabolic. You can't do anything about them. You can't prepare for them. When they happen, if they happen again, you're going to get hurt. So the loss basically is only because of market condition, and market condition looks like a unique instance on virtually all instruments that I've tested. So what I've done is I've revisited all of the original strategy development that I did 6 years ago, which was all of my ADR research, which was done over a 20-odd year period. And I've revisited all of my RSI research, which I did over, wasn't as long, probably about 10-odd years. I mean, I basically just went back on the chart as long as I possibly could visually. So I've run back tests on those using the Position Trader EA, and the new setting that I've put on that, which I forgot to talk about. New setting for which mimics what the original market reversal alerts EA did, which is on the RSI using candle close, not tick, not that one, RSI there. So last close candle instead of using live data. So again, I wanted to test. You can touch a level, get into a trade, and then it actually closed down there. What I want is I want it to be up, and I want it to be strong and pushing against me and closed above the level. Yeah. So again, and just another confluence or another security blanket, basically. That candle needs to be strong, and not only strong, it needs to close strong. Yeah. So I did all the visual back testing, which I slept at about 7 o'clock every night. because I was just staring at charts all day long, visually backtesting this. So the 4-hour 14 RSI, which has been my bread and butter, is still absolutely fine. What I have decided to do with the mean reversion strategy is switch to 80-20 4-hour. And the 80-20 4-hour is the 70-30 is the standard. But in these market conditions coming up over the next year, I think we're going to see some quite strong potential movement. So what I want is to be getting in on the strongest of those moves. Yeah. So I want to see the RSI extended way beyond the 80 and the 20 levels on the 4-hour. It's not going to give many entries. So it will sit there and it will do nothing for weeks on end. My back testing with the position trader EA has shown that you're going to get somewhere in the region of 1 to 2 entries a month on most instruments. So it's not going to trade often, but it's rare to get more than 3 to 4 positions on those trades. So what I'm doing is I'm basically reducing my risk profile down, which is going to reduce my profitability. But the chances of these types of movements hurting is not gone, obviously, because we don't know what's going to happen in the future, but it's very, very much diminished. So it's kind of just knocked me back a little bit into, that was a big one. We haven't seen that before. And looking back, it's unlikely it's going to happen again. But the question is, when these moves come in, they will happen again at some point in the future, and you've got to be prepared for it. So I'm going to diversify strategy by having this H4 would be the A+++ setups. Yeah. So going back through history, let's just use this chart for the minute. I'll explain what I was doing on the other chart. If we move these H4 lines up to 80-20, why? Yeah. So when you look back through pairs, the 80 line, the extensions are not that much. You got one there, you got a 20 there, you got a 20 there, you got an 80 there. There is a 20 here. You can't see it behind my head, and there's an 80 behind my head as well. So the 80 is there, the 20 is there. Sorry, no, it's not. Lie. The 20 is there. Yep. That 80, that 20. Sorry, no, that 20. That 80, that 20. Yeah. So this is a year going back to May 2023. We've had 1, 2, 3, 4, 5, 6 extensions on the pound odd. Yeah. So it's a trade every couple of months. But look at the strike rate and look at the extensions and look at the pullbacks from them. Yeah. This one here is not very big, but it doesn't look very big. But when you actually look at the size of it, it's 167 pips. That's 1.5 ADR. 1.5 ADR, 0.5% risk over an ADR is 0.75%. Yeah. Depends on what you're putting on as risk. You can use higher risk with this strategy because the strike rate is so much higher. So my goal basically is, and this is what I've back tested it with the EA, is to use higher risk, but only take the big setups. This is obviously assuming we are going to go into a high ADR volatility period. That we don't know. No, as I said, we can't see into the future. But instances like this today, for example, coming off the back of a run like that, is going to be a hell of a lot less painful. And I'd be willing to take less profit to produce more stability. Bearing in mind, we've come out of COVID into an 18-month interest rate rally at the size and speed of we've never experienced before, into a 12 to 18-month freeze we've never experienced before, moving into what potentially is going to be the fastest interest rate drop we've experienced. It could not be. We don't know what's going to happen. But I just want to make sure that I'm prepared in the fact that I'm trading the biggest, best setups. And I don't mind really getting a little overexposed on these. So if we get a massive rally in the pound and I take £3 shorts, I've got two other crosses that have got the power to make these two work out, and this one potentially maybe going to drawdown. So exposure is less important when you're taking setups that very rarely fail. So the downside obviously is way less setups. So I'm still going to monitor all the RSIs, but that's what I've decided. The other thing that I've been analyzing, doing analysis on, is when I first developed the position trading mean reversion strategy, I did a lot of searching on indicators. So I tested RSI, CCI, MACD, ADX, all sorts, a rune up, down. I tested loads of different indicators, all oscillators, because oscillators basically are designed to show you market condition having moved in one direction for a long period of time. So the reason I ended up with the RSI specifically for Forex was because it is relative strength between two currencies. RSI was always being used with stocks historically, but it works very well in FX because it is the relative strength between push and a pull partner. If you've got one pushing and one pulling, then you get a big RSI. If you've got two pushing at the same time or pulling at the same time, i.e. both having bear moves, both having bull moves, you don't get a lot of signals because you're not going to be able to get into much. So this is why I decided to use it. I did all of the analysis based on the median RSI, and I based it off of the different readings on the RSI. So I tested the 5, the 10, the 15, the 20, and the 20. Did I bother? No, I didn't test the 25 because it was too many signals. So too few signals, sorry. So I tested all those RSI versions, if you like. Yeah. So I've revisited all of that testing again over the last couple of days. So I've tested here. I've got the 5, the 10, and the 15 RSI, pretty much as close to the 14 RSI. So we're testing the relative strength over 5 candles, 10 candles, 5 candles, 10 candles, and 15 candles. And I wanted to see how many signals were produced by each. A little bit, this is exactly what I did before. So what I was looking for was the Goldilocks zone type thing, if you like. So I don't want too many signals. The more condition signals you get in the market, the more false condition signals you're going to get. The fewer signals you get, the stronger they tend to be. So the 5 RSI, which is this one in the middle, was too sensitive. These are the 80-20 levels drawn here. Yeah, too sensitive, way too many signals. In range-bound markets, kills it. When we get these moves, which we're trying at the moment to avoid, kills, absolutely kills. In some cases, doing the testing on the 5 RSI, it actually blew accounts with just one currency. Yeah, which is, again, that's just not an option, even with drawdown control. So just going to a parabolic move like that, and you just go to parabolic drawdown control and you'd never recover. So, but the EA wouldn't recover. As a human being, I would be looking at it and going, screw this, I'm out. Yeah, which is what you see me doing. Cut it. It's not working. Cut it. Got to get out. So the RSI 5, I wiped off. The RSI 10, which was a little bit less sensitive, worked very, very well. And then the RSI 14, which is what I used in the past. So let me just get rid of these lines. In fact, let me open a new chart and put those RSIs on just so that we can see it a little clearer. Just get rid of the 70-30 a minute. So this is, I'm going to use the 14, oh, not 144, 14. Just make those solid lines a sec so we can see them. Come here. Oh, wrong one. What am I talking about? Okay. Oh, I've just changed that. Bear with me a sec. Okay, so that's the 14. This is the 10, slightly more sensitive. And then the 5, which was the uber sensitive. So 14 on top, 10 in the middle, 5 on the bottom. So you can see that the 5, you can see how many signals you get on this thing. It's signaling every week, multiple times a week in some cases. Way too many signals. So if you're in this sort of state, absolutely no problem. When you go into that, you are going to get hurt, really hurt. Not an option. And again, that was my findings 6 years ago, not using that. Then I tested the 10, I tested the 15 and the 20, which is why I came up with the 14. And the reason I came up with the 14 was it gave me, and back in 6 years ago, I was much more like, oh, this is much better from a backtesting purpose. So there was less robustness testing involved back in those days. And I thought the 14 was slightly better. 14, 15 doesn't make any difference. Either or, one or the other. One of them will work, one of them won't. But the 10, as you can see, so looking at these two as a comparison, I'm just going to get rid of that one. So looking at these two as a comparison, you've got one there, one there, one there, one there, one there. And this is the RSI 14. So this is my bread and butter that I've always used. Yeah. The RSI 10 gives you the same signals. Yeah. You will be in ever so slightly earlier. Now, the difference between the RSI 10 and the RSI 14 is a candle, maybe two. So 2, maybe 1 4-hour candles. That's the difference in the entries. But as you can see, there are way more entries on the RSI 10, but nowhere near as many as using the RSI 5. So all those there are entries. So instead of having 1, 2, 3, 4 entries on the 14, we'd have had 1, 2, 3, 4, 5, 6, 7, 8. Roughly twice as many entries. Gets you in roughly once a month on average. So I still haven't decided 100% yet what I want to do, but the RSI 10 is looking like what I may well try and use, because if you're going to get into these squeezes at this point on RSI 80 on the 14, you're going to get into them anyway using the RSI 10. But the RSI 10 will give you a lot more extra opportunities. But with this, because it's more sensitive, I would want to probably use some kind of trailing stop mechanism so that once it's moved down by 3/4 of an ADR or something, just to protect it, because it is more aggressive. So what I'm toying with the idea of doing when we go through the interest rate drops, first of all, definitely changing back to what I used to do, which is 4-hour. The market is getting more volatile, and I think the hourly time frame is now getting a little bit more dangerous. So it's a case of just adjusting back to the usual old ways, which is where I all started out. So the 14 on the 4-hour. The 70-30 level is still pretty good. This RSI 10 on the 4-hour is kind of equivalent to something like a 75 RSI level, 75-25 on the 14. So obviously all you're doing every time you're changing signal indicator inputs is you're just adjusting the strength of them. So if you adjust this back to a 14 and then change this line to a 75, you'll get roughly the same signals. So it's not that far out. So all I'm doing is looking at less trades with higher probability and more protection for most of them. This one, I wouldn't have a problem. Yeah, so if you go over to any instrument, doesn't matter what it is. Yeah, it's very, very, very reliable. Yeah, you will always get at least an ADR out of it. apart from in, like I said, this situation that we've had for the last 3 weeks, there's nothing you can do about this. This is just not something that's happened before. So in normal instances, this would have been an entry there and a move of, I've got ADR on it. $22. So that's about a 3 ADR move or so. So yeah, that's the plan moving forward. I've been working on a hedging strategy for ages, like a long time. You've probably heard me talk about it in here before. But I've been working on a hedging strategy for a long time. And last week, I also took the opportunity to revisit one of my mentor documents, which like when you follow anybody, if you've been following me, you write loads of notes. And I've got loads of A4 Word documents, basically, which is me just writing down the stuff that's important to me. That's how you learn. When you do any course, everybody, if you gave everybody the same course and then gave them a quiz at the end, half the people would know half the answers and the other half would know the other half of the answers. Because if you already know the answer to something that someone's just told you, you disregard it. You only note and take note of the stuff that's important that you haven't heard before. So I revisit. When I do any training, I write my own notes, which is like, that's interesting, not thought of that, didn't think about that. That's a different way of looking at that. And it's important to me. Everybody will have a different thing that's important to them they get out of training. So I revisited one of my mentor's notes from when he was teaching me. And basically, the whole ethos of why I developed position trading was the fact that you cannot get your entry right. And this is one of the things that was drilled into me. It doesn't matter how much backtesting you do and how many times you see something happen in the past. When the next time that thing occurs, the odds are the same. The market will either go up or it will go down. It's binary. It's 50-50. Doesn't matter if it's got a 100% strike rate in the past, like the moves we're seeing at the moment. Yep, 100% of the time when we've hit that, it's always done that. No, this time it didn't. Yeah, it's always going to be that because the odds are always the same. It's 50-50. Every time the market achieves a price, the conditions in the market right now, when that price is achieved, are never the same as the conditions in the past. Interest rates, unemployment, inflation, market positioning, how many banks are in the instrument. Everything is different here than it was here. Therefore, the movement that precedes that or comes after that is never going to be the same. So one of the things that I got back out of that, rereading that document again, which was a real blast in the past, but was the fact that the market basically is binary, as we know, and it will only go up and down. And your job as a trader is to, like I said earlier, to be right in the direction at the time the market moves. You can have a directional bias on something and be wrong 1,000 times. Being right once doesn't get rid of those 1,000 times you were wrong. So the hedging strategy that I've been working on basically works on that principle. And it looks for basically a way to build a position the same way as the banks do. Again, if you go back to Bootcamp day 1, in there is taught bank movement. And bank movement is basically during Asia, the banks and institutions build a position. They pass that position on to the London bank. And then the London bank is told that they have a net long or short position. And they will then take the market in the direction of their position at that time. And then they will pass that over to New York and say current positioning is net long, net short. And if it's net long, New York will try to take the price back up again. That's all banks are doing. They're building a book. That book is either net long or net short, depending on the number of orders executed within the book. And then the market is driven in the price of the direction of the price that is going to make them the money. Yeah. So the the strategy that I've been working on for ages is basically to replicate that principle. Yeah. So we build a book and we wait for these moves to happen. And over the last 12 months, we've seen so much of that strategy is exactly what it's built to make advantage of, is this type of market movement. And when you see things like this happening, this is payday for that type of strategy. Like I said, breakout, it's a breakout strategy. We're basically accumulating and distributing exactly the same way as the banks would. So what I'm planning to do is, as well as the normal position trading RSI mean reversion, I'm going to develop that further and try and get the diversification in with that, and obviously just do the normal stuff with the indices. But I need diversification because it's taught me a lesson this first 6 months of this year. I'm down on the year. It's the first time ever I've been down on the year 6 months in. And something needs to be shaken up. There's nothing wrong with the strategy. The strategy works when the market conditions are right. The market conditions at the moment, as we know, have been very erratic. So it's just a case of protecting capital and lowering risk while these conditions are going. And there will be a point in the future, I'm sure, where I will switch back to the hourlies, because I did initially. Because if I sit here for a month or 6 weeks and I haven't taken a trade, I have to switch. It's not a case of, oh, I'll just wait for the market to come back. If it doesn't come back for a year, what do? Got to do something. So, but having the diversification as well with a breakout, the trend-based strategies as well. I spent a little bit of time, say a little, 3 hours maybe, last week, looking at all of, not all of them, but most of my trend strategies that I've collected over the years. And I've thrown I've never traded them because trend trading just doesn't work. I don't care what anybody says. I've never met a trend trader, profitable trend trader, never met one. Because the principle of market structure means that trend traders always get stopped out at a break even or with a very small loss, a very small win, or they take 50% of their trade off up here, which means that every trade that they do actually make profit on, they only take half of the profit and let the other half stop out at break even, which means that your risk reward ratio is 50% of what it should be in your testing, which doesn't work. So, it just doesn't work from a mental perspective. People cannot hold trends. You can't do it. So I've revisited all the trend trading stuff that I thought was good. And every single one of the strategies starts with a breakout. That's what trend trading is. When you see a breakout, you wait for a pullback, and then you assume that the trend will continue and you add into that trend. Yeah, which most of the time they just don't hold long enough or make enough movement for you to make money out of. Because your stop or risk is always too big on the trend because you need to give it time to room to breathe. But it's given me a good couple of extra ideas on initial entries for the breakout hedge strategy that I've been developing, which I want to sort of investigate a little bit further. But very similar to SIH, but obviously on higher timeframes for FX, basically. So it's just looking for contraction breakouts, basically. But there's no stops. It's a hedge system, hedge strategy. But I'm struggling a little bit with certain elements of it, which is why it's been on the back burner for months and months, because every time I get to a point where I think that works, I find an Achilles heel. And it's trying to eliminate the Achilles heel, which is the hard part. And the only way that I've so far found to do it is by scalping, which means you're taking 20 to 30 pips out of the market or so every time you get one, but it will go into fairly wide hedge drawdown if you go into a long period of accumulation. So as I say, every strategy you will find out there works really well in certain conditions and fails in the others. And it's finding an edge that gives you a higher percentage of opportunities to make money. That's what it's about, isn't it? Which is why we mean reversion trade, because mean reversion works in breakouts, it works in trends, and it works in ranges. Yeah. That's why I'm a mean reversion trader, because 90% of the time the market is doing some kind of mean reversion. Even if it's trending, it's mean reverting on every pullback. If it's breaking out, usually it will either be a failed breakout, which is a mean reversion, or a successful breakout, which includes a mean reversion. If something is ranging, it's mean reverting constantly. Why would you be a trend trader or a breakout trader when it only does that 20% of the time? 80% of the time, it's going up and down, mean reverting. So it's just trying to put all of that together in a risk repeatable way, which is what the the other strategy is kind of about. These are looking brilliant. These mean reversion, these false breakouts. So anyway, that's the plan. So I just wanted to cover the research because I said somebody asked me, I think it was AZ, going to go through it on Monday. And there's not really a lot to go through, although I seem to have managed to waffle on about it for about 40 minutes. But anyway, so that's what I spent last week doing. And the ADR research as well, I forgot to mention. The ADR research that I initially did, I reran all of that research again using the data for the last 5 years. So 1 year post-COVID and pre-COVID and the post-COVID era to make sure, and this is the important part, to make sure that these percentages are still correct. So these are still correct. Yeah. So these percentages were based on around about 21 years of research and data. So these basically are the percentages of the year that it gets beyond those levels. So only 2% of the year will it go beyond 225% of ADR across all Forex pairs. That is still the same, except the ADR ranges obviously are much more contracted. But when we do get those moves, the moves are also more contracted. That's what I wanted to test. So this period that we are going through today, this is a complete abnormality. Yeah, this hasn't happened. And it's good that this happened today because it kind of reproves what my research was that I did last week again, which proves the original research I did that ADR is the only way to make money in the market, because if you're not adjusting to the average range of movement, your system or strategy will never be repeatable. So, yeah, it's good that this has kind of happened today. It's just sort of shoehorned and confirmed that for me. But so yeah, so that's what I was doing on the research. So ADR, again, still the same, very reliable, and from a risk tool, uses risk management, and obviously the more contraction you get, the explosions are more contracted as well. So it's all based around news. All these ADR hits that go beyond these levels are fundamental news shifts, which is why when you see this sort of thing happening, it's a case of they're not opportunities, they're warning signs. What's going on? This isn't normal. I shouldn't be doing anything. When I launched this morning, I launched my laptop. I was lying in bed with my coffee, opened up my laptop, ADR dashboard. I was like, broken. So immediately went to look at what the problem was. Realized there wasn't a problem. It has actually done 225 ADR before I've even got out of bed. That's a reason to go, we need to have a look at this and not bother trading. Yeah, because this is, weekly ranges are not hit this early in the week. When have you seen this? You've been in here regularly. It's never happened, is it? So you want to sit back, relax, and wait for this thing to figure out what the hell it's going to do from here. But lots of opportunity out there, but with opportunity comes great risk as well. If you want to short this 4-hour candle with a stop loss, your stop loss is about 200 ADR. So if your reward is 200 ADR, worth it? Just let it settle. Yeah, you're not going to get very good risk-based trades on in these conditions. Jeremy, hearing your voice after being without for 2 weeks while having to endure this madness feels like seeing a glimpse of a lighthouse in the most perilous of storms. God, that's poetic. Yeah. I'm not a very good lighthouse keeper at the moment, I have to say. I don't think anybody is. I think you'll find... I mean, you'll always find the odd people out there going, I know exactly what to do in this condition, but they won't back it up with why. They'll hope, and then they'll go, told you, and then they become the next guru because they called this. Yeah, plenty of people have done it in the past, but you know, you go do it yourself. Don't listen to me. Don't trust anything I say. I've never trusted anything anybody has ever said. I have verified everything that everybody's ever said. Yeah, when people tell me that there are limit orders placed at highs and lows of weeks and months, I didn't believe them. I went and tested it, and I was like, Jesus, they're right, you know. That I did this, I tested it, I made sure that was the case. And does it work all the time? No, it works half the time. Everything works half the time because the market is fine. It is binary with a 50-50 chance. So yes, 50% of the time, when it hits it, the limit orders will be enough to turn the market. Sometimes when it hits it, the limit orders will not be enough to turn the market, and the market strength in the opposite direction will break it out. What happens here is based on today, not that peak. Nothing to do with it. Everything in the past is past. What is today is today. Yeah. If Libya sends a rocket into the middle of another country today, I don't care about that, and neither does the market. It's got bugger all to do with what's going to happen today. This thing will either go up there by 500 ADR or there by 1,000 ADR. But it's got nothing to do with what that peak that you saw achieved in August last year. Today is a different day. Things right now are very different to that. But in normal world, that will happen, won't it? I just want to express my gratitude for your wealth of knowledge. That's okay. You will also have a wealth of knowledge after you've spent 15, 20 years being tormented by these markets, as anybody that's been in there for a while will know. Right, so that's all I've got for you today. As I say, that's all I've got for you. I've been on for 3 hours. So this week, basically, I'm going to continue doing research this week and development. And I may well get into some positions this week. But at the minute, even RSI 14, 80, 20, there's too much. There's too many opportunities here right now because of this last couple of weeks of movement to go, I want to be on that. I mean, I would love pound Swiss. I mean, 5. It's too good to be true. But look at the price action here. Look. Yeah, we are going bear again. I just don't trust this market at the moment. I need to see it chill after today and after last week. So I think this week is going to be a little bit sitting on the hands. I'll still be doing SIH this week. But again, like I said, I'm still going to do it this week. I'm just not going to do it today because if we've moved 200 ADR before the market even opens, we are looking for norms, don't forget. We're looking for repeatable norms to give us an edge. It's just not normal. So if it's not normal, it's a coin flip at the open. Everything's a coin flip, but today that is really a coin flip. Yeah, at 2:30 this afternoon when that thing opens, it could do absolutely nothing. It could go 300 ADR in the other direction. I've no idea. Yeah, one bit of red news on financial juice, and you could see that thing collapse. You could also see it pump the other way. Fed could come out this afternoon and say, actually, no, we're not going to bother with interest rates. We will see. But yeah, so just be aware of your news coming up. So this afternoon, we've got PMIs at 3 o'clock. And then tomorrow morning, you've got the Aussie rate. So if you have got the exposure on the Aussie and you have got any exposure on the US dollar, just, watch. If you get, my advice at the moment is just, if you can get back to a level that you can get out of anything you're in drawdown on, do it. That's what I did last week and just wanted out and flat. And it's cost me money. But I'm sitting here now waiting to figure out what the thing's going to do next rather than having risk on when, it could be a very volatile movement of any news event that we see. So, all right. So I'll be back tomorrow at 2:15. Live rooms all updated again on the website. So 2:15 tomorrow, back to normal sessions, and we will trade the open of the New York exchanges tomorrow, bearing in mind, assuming that they haven't gone mental, and then we'll see where we go from there. But I'll update you on what I'm going to be doing with the strategies, and obviously in due course when I've completely finalized it. But looks to me like 4 hours is the way to go now, just until we got an understanding of how volatile we're going to be. So, all right, have a good day. Hopefully everything goes your way if you're in DD on any of these, and I will see you in the next session. Have a good one.